Good evening, everyone. I'm Ghazal Jain, and it is my pleasure to welcome you to this very special webinar. Mr. Ajit Dayal, founder, Quantum Advisors, and Mr. Ivy Subramaniam, MD, Quantum Advisors, are the essence of quantum, the strong foundation that has brought us where we are today. And they are completing 25 years of working together. Quantum Mutual Fund is a product of their innovative thinking, honest approach towards business, and influential leadership. Today, Ajit and Subbu will take a trip down memory lane and share their experiences on everything from evolution of the mutual fund industry, the epic market cycles that they faced, and what it took to build a fund house with an investor first approach that helps investors grow their money with integrity. Thank you, Ajit, and thank you, Subbu, for being here with us today. Our speakers would love to hear your thoughts and views, so we encourage you to send across any questions or thoughts that you have for them on the chat. I will now request Ajit and Subbu to take us through their journey and share their experiences and learnings along the way. Over to you.
Thanks, Ghazal. Subbu, congratulations. Actually, the 25th year technically is June 3, but we're celebrating one day earlier, I guess. And, I wish we were all in person to commemorate and mark that wonderful occasion.
Yes.
You had
a great journey, and thank you.
Yeah, you had surprised me early this morning by sending me the appointment letter, which was dated May 1st, 1996. And I'm going to surprise, and of course, saying that the start date will be June 3, 1996. And I'm going to surprise you with an entry in my diary, which I've still kept from 1996, where I've
wow.
on April 29th, which was a Monday, we met at 2:30 in the afternoon.
Right.
April 29th, we met, and May 1st, I gave you the letter. So what was that fabulous impression that you made, which said, okay, this is the man?
I was just recollecting that time, because I remember if I was joining on June 3rd, I must have got the appointment in May, and Bombay, I was from my earlier office for this interview in the afternoon a lot, and I was wondering what impression I experience. You look, you are today as you looked in those days. I remember very well that among the many questions that you asked, there were a few which was completely, I didn't expect it. It was not related to ratio, price to book, which I had studied very diligently and came for the interview. It was all about who influenced you in your life, what kind of events influenced you in your life. And I remember very well that there was a Mahatma Gandhi picture in that room of Mahatma Gandhi, and I just looked at that picture and just wait for a few minutes. I will let you know the outcome of the meeting. And I think in literally 5 minutes, you said, please come and collect the letter after a couple of days. So I don't know what impression I made, but I was very, very impressed by the speed at which you react, how comfortable you made me feel on. I was, the time was a very peculiar timing, because 96, probably the last jobs in equity research were open. House was pretty much full. I had just moved from Hyderabad to Bombay. I was not a Bombay person at all. And I was still wondering whether I'll get this job or not. And I was keen to work with you, as I had heard a lot about you at that time. And it met a lot of my aspirations and dreams as to what you wanted to build. So overall, that day was very interesting. That day was very important. And I'm very glad that I made it into the quantum team. I remember two of my friends had also done interview with you. One did not join and the other did not make it. And I'm very grateful that I got the chance to work with you.
Yeah, exactly. And, so since you mentioned the Mahatma Gandhi quote, right? So in the Mahatma Gandhi quote, it was the means is as important as the end. And that's something that I think even in Quantum Mutual Fund, we've ensured that that philosophy and that approach remains, in that sense. But Yeah, I also remember another thing going back, and I made these notes last night, so I get the numbers sort of correct rather than wrong. It was that you joined in June 1996. The BSE 30 index was about 4,000 or so, 3,800, 3,400. It was kind of bouncing around in June. And the market fell by 30% between the month that you joined and the end of the year. Between that and December of 1996, the BSE 30 index fell by 20%, by 30%. And the daily turnover in the Bombay stock market at that point in time, on average, was about $400 million a day for that year, starting April 1, 2006, sorry, 1996, till March of 1997. So the average, and that average of 400 million was more than 250% increase from the previous year. So we were
Right.
seeing this increased activity in the markets, just as just as the time we were doing sort of quantum, version 2.0 in my post Jardine Fleming days, and the market cap for the entire stock market was USD $63 billion at today's exchange rates.
Right.
So about a $60 billion market compared to today where we're 2 trillion and counting. So a much smaller market. Of course, daily turnover has increased. Last night I noted that just index options on the NSE trade about $280 billion. That was the data for 2 days ago. So a lot of activity has been, since then. Even the BSE 30 index in August 19th of 1996, out of the 30 stocks, they removed 15
15 stocks.
and they brought in 15 new ones.
That's
So there was a massive churn, and there has always been a churn, which is why we're not index believers, but more on that later. There's been a massive active churn in the indices, and there was a dramatic churn in the day in the month when you had joined, the period when you had joined.
right.
But going back a bit on this sort of philosophy part, right? We talk about certain quotes, certain philosophies, approaches that we've had. And, we spoke about the one of Mahatma Gandhi, where the means is as important as the end. The other one, if you remember, was from Jamsetji Tata, where we were all inspired and saying, hey, he used to always say that the focus of business, that if you look at the broader community, the community itself is a stakeholder in the business and not a byproduct per se, where you sort of hand out 2% CSR and you're seen as a good person. So that was another thing that kept us going over the years, and things that you have added to over the years. But I think if I recall correctly, April 1996, April 22nd, 96, just a few months before you joined, Riaz was there, who's now no longer with us, sadly, and he had put Equity Master on the website. So we were the first Indian financial portal to go on the web in April 22, 1996, now known as Equity Master. So if you kind of track back, right, Subbu joins as the analyst in quantum in 1996, and then we had these partnerships with the group out of UK, Prolific Asset Management, where we launched a fund with them on the London Stock Exchange. Then we had the partnership with Walden, where we set up India's first VC fund, where Rahul Chandra, no longer with us sadly, but happily is doing great things on his own with his own VC firm. And thirdly, we had the partnership with Hansburger. So I know we've always talked about the Hansburger partnership. Do you want to touch a bit upon how that changed you as a person and your evolution from what we learned at Hansburger Global Investors?
Sure. At quantum, we had prolific out of
Subbu,
UK.
you may want to close
It
your
was not a
video.
pure value fund. It
Sorry,
was a
Subbu, you may want to
combination of,
shut the video because, yeah, thank you.
yeah, sorry. Sorry about that. So I said before I speak about Hansburger Global Investors, I will just touch upon the first year's experience where the client was Prolific India Opportunities Fund out of UK. And it was not a pure value fund, it was a sort of value plus growth. And even that 1 year was a great learning experience from a variety of angles. And one of the main things which we learned which made my life a lot more simpler, was to write simple reports. So the first report which I wrote, Ajit, and all my friends who are on this screen, was actually on Tata Motors. And I joined in 1996, and there were all these big broking houses sending large reports. And I was under pressure that I need to write a large report to impress Ajit. So I wrote a very detailed report and I showed it to Ajit. He read it very patiently. And then he came back and said, why don't you just convert it into 8 points? Four as to why do you want to buy Tata Motors, and the reasons for not buying Tata Motors. As simple as that. So an entire 5 page report got crunched into a single 1 page or a 2 page report, and that was very beautiful experience for me, because at the end of the day, if I read all the 5 pages, the real gist is why do I want to buy the stock and why do I want to avoid the stock, and that simplicity helped me in writing many reports in that year. And then by 1997, we were ready to tie up with Hansburger Global Investors. Tom Hansburger, as you know, is a legendary person in the US. He is one of the co-founders of the Templeton Group, Templeton, Galbraith, Hansburger. And Tom was initially very keen to build an India team. And I was looking at his portfolio in India. At that time, I think it was just about $75 million. And they had stocks like Garden Vareli in the books in those times. And we had to clean it up and bring in some high quality stocks. But that journey was very important from many ways. One, the importance of processes. I always thought research was a something like a maverick coming up with a theory and thesis. But he put in a process. He put in a process as to how do you look at history, how do you look at future, how do you build models, and that definitely helped. And Tom, as well as you, Ajit, at that time you were operating out of the US. You encouraged me to write many reports. You encouraged me to go and meet many companies. And the first target was to build a database of, I think, around 100 companies or 150 companies. And I began that work because we had to showcase it to Tom Hansberger that there is a vibrant database available in India. So that entire exercise helped a lot. Subsequent to that, I think by around 2000 is when we started looking at global companies. And you were looking at, I think, consumer staples, and then you gave me the opportunity to look at cement on a global basis, and then utilities in emerging markets. So I had a chance to look at, say, Cimex in Mexico, to Holcim in Switzerland, to CRH in UK, add to that companies like Saint Gobain, and then all the utilities in Asia, particularly the large ones out of China. So that experience was again a great learning experience. How do you look at an Indian company, an Indian cement company? At that time, used to write off their assets over fairly long periods of time, while a typical international company would write it off within 20 years. So that learning helped me in understanding the cement companies in India better, change the numbers, change the assumptions and growth rates and depreciation rates, and value them accordingly. So subsequent to that, I think you started looking at insurance companies.
Correct.
And while I did not cover insurance companies, but I learned a lot about insurance companies. We had a colleague at that time who was looking at consumer staples. So I remember visiting Nestle at its office in Switzerland and trying to understand the chocolate companies, the consumer staple companies. So all that experience was useful in translating it into numbers, in sharing it with all the new analysts we had hired at that time, and handing over some of the thoughts, some of the models, and the processes. I think that was a solid laying ground for us before we launched the mutual fund and the international business which we have today.
Absolutely. I mean, I remember having the discussion with Shankar, who was with us at that time and sadly also left, and that left two of us as partners because Shankar was no longer there. I remember having the discussion about should we take over the Hansberger partnership, because it meant surrendering the Walden venture capital funds, and it meant basically surrendering Prolific. Although Prolific was purchased by Aberdeen, so anyway, they would have basically kicked us out, or unless we joined them as employees. So what you see today as the Aberdeen India Fund with billions of dollars in it was what we had started with Prolific. recall. I remember the discussion about Hansburger, and and I think it's important that our viewers understand the impact that Hansburger has on us as a firm and as individuals. You spoke about your ability to track companies around the world, to go and meet companies around the world. You were traveling across Asia. You went to China multiple times at that time to do research. You've been to the US to meet the Hansberger team members on the investment side. And I think that sort of laid the foundation for the value discipline that we have. And I probably shared this with you in 99, 2000, at the time of the tech bubble. The Hansberger Global Funds, which were value funds, and at that point in time, we were selling out of all the tech stocks. So NASDAQ doubled between September 1999 and December 1999. So in 3 months, NASDAQ doubled, and we'd already sold our large TMT holdings that we had before when they were value. And we looked so poor on a global basis. So at that time, we were managing global money. I was part of the global team. And I remember a very senior board member of what is now defunct, the Bear Stearns Broking Company, had flown down to Fort Lauderdale, where I used to live and work with Tom. Um, and we had lunch with him. And this gentleman who was Tom Hansberger's age, so that time in his late 60s, he told Tom, he said, Tom, you and me as value investors, we are dinosaurs of the investment age. And, this board member, elderly board member from Bear Stearns, he said, I have started buying AOL and Yahoo and, those kind of stocks for my grandchildren. I'm no longer buying steel and cement stocks. And I remember so clearly that was February 2000. So it was still optimistic times for NASDAQ and for the tech bubble. I remember going back to the Hansberger office, and Tom closed his room door, which he rarely did. And I really felt there was going to be a gunshot sound soon, because here was, this other gentleman, Tom's era, Tom's generation, telling Tom how he's a dinosaur and the whole firm is going to blow up because value investing is dead. And we know what happened from March 22nd of 2000 when NASDAQ collapsed, and it took years for the NASDAQ to recover its peak levels. Of course, now it's gone higher. And one of the big discussions we've had in the last few years, so between 2019, 2018 end and 2020 March, just prior to the pandemic, value has been a pathetic performer. And to some extent, I always remember that we've been having a lot of discussions. Is value dead? Is value over? Are we dinosaurs? What should we need to do? All of that, right? So you've seen the way Tom was sort of depressed. In some sense, were we ever depressed in 2018, 19, 20? Or were we convinced that value was an option, a sensible option, a sensible part allocation for long-term investors? Would love to, hear what you went through as the person driving the value fund, the international value fund, where you manage about 20,000 crores for international investors in India, which also may not be known to many people. But Quantum Advisors manages 20,000 crores plus for international investors, and then the India Quantum AMC Value Fund, maybe 850, 900, 1,000 crores. So would love to hear your views on how you went through that stress of value not doing well in 2018, 19.
Yeah. Uh, so it was stressful. So I'll again step back a moment. Like as you said, you shared with us your experience at Tom's office, and I distinctly remember that entire talk about value being dead. And I think around 2003 or 4, I forget, you and me had actually gone to meet the CIO of the largest mutual fund in India at that time. And at that time, it was not about value versus growth, but he made a statement: equity as an asset class is dead. So why do you want to get into equities? And we were trying to do some sort of tie-up with them, and he said equity as an asset class is dead. And probably the biggest bull run started since that talk. And in a few weeks' time, we saw the bullish movements within the market and the flows being very high. So one of the thing, when I combined this statement from this gentleman who was a CIO of a very large company, and what you had shared with me, one thing was very clear that there could be periods of pain, long periods of pain, and sometimes you may crack under it and you may come up with these theories that either value is dead or growth is dead, etc.
Yeah.
But the fact is that these are cycles and it will eventually change. So that learning helped me to some extent manage the overall period, like let's say from 2006 onwards. But 2018-19 was very difficult, because while I definitely believed in the value theory, I definitely believed it's a very sensible way to invest. And for a lot of conservative people, it was a good way to build assets. But it was disappointing to see that the performance was not picking up, and because it had other implications, right? You constantly worry about clients getting worried, and whether clients will pull out money. That has an impact on many other things. So while I was convinced that value was great and one should follow that, of course there are a lot of learnings. We re-looked at our processes, whether we were going wrong, because the world had changed, Ajit, between the
Yes.
time Tom ran the value fund and now. And one of the biggest changes, has been interest rates. Interest rates, which were very normal at that time, is completely, I guess it's 1/20th of what it was, or 1/15th of what it was in those days. And that had an implication on returns, on the way you look at companies, on the way you look at valuations. But at the same time, for a typical value guy, even if you put all that into a mathematical model, to justify buying a stock at 40 times, 50 times was just not possible. So in theory, I could say, Ajit, I could have bought Nestle because it was value. But when I look at, say, absolute valuation of 40 times or 50 times, I can't take that step. So it was a difficult period, but we stuck to it. We relooked at our assumptions. We said we should constantly search for catalyst. One of the thing in the value fund is, one is valuation, and then what are the things which will unlock the valuations? When do the catalysts come into play? So that became again a critical factor, and we recognized that maybe the environment was such that the catalysts were getting delayed. Like, we typically owned some of the PSU stocks because we found value in them. The PE ratios were low, dividend yield was good, but then there were no catalysts for these to unlock, which eventually turned in our favor in 2020. Similar is the case in 2018. We in the After the ILFS financial crisis, we bought into a lot of financials because there was value in that, but then it didn't play out, and then eventually in 2020 it picked up. So personally it was difficult to also explain to the team, should we really stick to value, what kind of changes we should bring, and if at all we bring, it cannot be completely a new way of looking at it. It can't be what a growth manager does, because there won't be any difference between us and a typical growth manager. So within all that constraints, we, I think, re-looked at the processes. We understood where we were, and the whole environment of pandemic and subsequently value being recognized helped a lot in feeling convinced that the problem is the value, but catalysts can take some time, longer than what you expect.
So, I'll just say another quick thing, right? I mean, we're talking about the value fund because you and I are trained value investors. But when we built out Quantum AMC, we got the license in December 2005. The first fund, obviously, was the Quantum Long Term Equity Value Fund because we understood value. And that the first NAV was 13th of March 2006. So we've done 15 plus years of the value fund with a very respectable track record. And I remember when we were building out the AMC, we said for the international clients, the global asset allocators, the large pensions, the large sovereign funds, the large universities, they can allocate money across different buckets for investing in India. And we can be the value manager. But we said when we build out Quantum AMC, we must have a complete solution in house.
Yeah.
And so we encouraged a team. You've trained the team fabulously well because they're all doing superb. We encouraged the team to think of new ideas. So 2019, we launched the ESG fund, which has got much higher PE multiples. If you look at PE multiples for that, you're meant to look at only ESG criteria than say the value fund. And then we launched this path-breaking quantum equity fund of funds, saying that, hey, Quantum understands how to manage money. Quantum, with the help of personal FNs, the database and research, will build this product where we allow you as a retail investor to give money to a bunch of different styles: growth, multi cap, large cap, small cap, mid cap, whatever they may be. And effectively, by allocating money within the quantum mutual fund complex to quantum equity fund of funds, to quantum ESG, and of course to quantum value, by buying these three products in a ratio where we suggest you put 65, 75% of your money in the equity fund of funds, and you split the rest between India, ESG, and value. By doing that, you basically allowed investors to come to one fund house and get a solution for all your equity needs without worrying about a value bias, right? You and I have got much of our money in investments in mutual funds in the value fund. Whereas, because that's our belief, we were trained to think that way. But, if you think a bit about the complex that we built in quantum mutual fund, right? So having been there 15 years, and we've always said we'll build a firm with high integrity and high competence. So we've shown the competence, we've shown the integrity, and yet we're like at the tail end of the fund industry. What would your message be as a fund manager analyzing a company? So you're looking at quantum mutual fund, as a company, as an analyst, and you're saying, what should that company be doing? Or what's the pluses and minuses for it to get more visibility and get more people to understand what we built?
So as an analyst, if I have to look at quantum AMC, clearly when I analyze a company, we look at, say, the products, we look at the volume growth of that products, whether you have the pricing power, and then eventually the profitability of the firm. So when I look at quantum AMC as an outsider, as an analyst, I can clearly see that quantum AMC has got the products in place. Like you have in FMCG, what you call the mass product, then you have the premium products, etc. So you can differentiate even the quantum products into a variety of ways. You can say gold is for some kind of people, fund of funds could be for a larger number of people, value as a style could again be suitable for a certain kind of people. So from a product suite perspective, I can understand that the company, the Quantum, has, I think, almost all the products which is required to address the market. But I would look at the distribution as to what are the challenges on the distribution, why they are not able to grow. I can fully agree that Quantum has taken a unique path, and that is to go digital, to go direct, and not use the conventional model. And therefore, I, as an analyst, am willing to give a good amount of time for that model to be proven. And now the question is, has the model been proven? I think it has been proven. If I look at the data right from 2006, I think I was very happy. I think I shared with you when we hit just 100 crores on the AMC. Ajit, just realize it's a market where there are a lot of distributors, and we have raised 100 crores without giving a single dollar or pence or a naya paisa as commission, right? So from 100 crores, we are now close to 2,000 crores on the AMC side. So the model is definitely working. The messaging people are realizing. I think somewhere down the line, we have to see how it can be scaled up even further. Maybe we have to have more writings. Maybe we have to tie up with somebody who has got digital connections. But the way I am differentiating is I don't see a problem in the distribution, but I'm saying that I have to look at it whether this company has the ability to scale it up. I think it has the ability. I think it has the content. I think it has the people. But so therefore, I expect it for it to get that typical hockey curve which a normal mutual fund gets, and that is what a company like Vanguard got it many years ago. And I know we at Quantum, we are trying to model a Vanguard model. And if you look at the Vanguard AUM, it was pretty much flattish for a long time. And this was when they did not have internet. They used normal telephone lines to reach out directly. And then you saw suddenly, I think at some point, what they call the critical mass kicked in.
Yeah.
So at Quantum AMC, I think as we get more number of investors, there could be a critical mass wherein you may grow much more rapidly. What is that critical mass? There is no magic number.
Yeah.
We have to keep trying what we set out to do. and then eventually it will convert into other
But you
number
know,
of.
the other important thing, of course, what you spoke about is that A, we did not use distributors initially. Now, of course, we use them
Yes,
only because they become more transparent, and that's what we
yeah,
wanted. We never were against using distributors.
that's
We just said distributors should disclose the commissions they get for, you know, showcasing to
be
client fund
transparent
A
and
versus
tell them.
fund B
Yeah,
versus fund C. That
yes,
was, and that happened with the SEBI rule. So we happily signed on with the distribution channels. But you know, the other thing that we've been discussing over the years has been the capacity, right?
yes,
So I wrote an article in The Honest Truth on Equity Master some years ago, where I looked at many of the small cap, mid cap funds, and I looked at the top holdings, and I did an article on how many days of trading it would take to actually sell out of that fund, and you know the top names, even the more liquid names, and in some cases it was one whole year, in some
mm,
cases 6 months, in some cases 3 months. So a lot of the funds are supposed to be liquid. So that's what the net asset value concept is. The concept of net asset value, as we know, is that if you were to immediately sell out of the portfolio, what will I get? The kind of the breakup value, or you know, distress value, if you will, in the market, right? If I was to sell every stock that I own and pay back my clients' money, and we've used that discipline. And I know we can soon turn to the questions, because I know there are questions around this out there. But you know, when we looked at the capacity, right? So if today the quantum long-term equity fund is 900 crores and the equity fund of fund is a few like 100 crores or whatever it is, if you look at the capacity of these products, it's like tens of thousands of crores, right? We could get that much more AUM and not change the portfolio at all. It would be
yes,
the identical portfolio that we have,
yes.
right? And when you look at other funds or other fund houses or other styles of investing, do you see other fund managers measuring capacity? Do you think that SEBI should actually put a capacity limit? So if you are Bajaj Auto and you want to manufacture school two-wheelers, you know, motorcycles, you get a license of how much you can manufacture. Or your, if you do not have the license, your plant capacity can't be more, otherwise you won't have enough paint or you won't have enough, you know, seats or whatever for the scooter. So do you think that other fund managers should look at capacity, or is it just a waste of time and a statistic that only quantum looks at?
I think they should definitely look at capacity. Although I have a few friends in the fund management industry. When I talk to them, uh, uh, they have a rough idea, but they don't have a mathematical number to it as to what should be the capacity of a fund. And I think it is useful to have it from many ways, particularly if you are in the mid cap space and the small cap space, because you know then if you are taking more money than the capacity, then you are actually diluting the process, you are diluting the philosophy, and the returns are then not comparable between what you achieve and what you historically achieved. That's something which is seriously lacking in India, and it's not. It's been now what, since 2006 we have been tracking or following the mutual fund industry, and I still don't see many comments as to what is the capacity of a particular product. And even if the few interactions which I have had with, say, a typical small cap manager, they have a broad sense, but then they don't have a number at which they will put a hard stop. They may still continue to accept money even after that is breached, but not necessarily put a hard stop. So to answer your question, it is important to have a capacity, and it is important to state and actively track it so that we don't
Right.
breach that and have other kind of liquidity problems in the
Great.
portfolio.
Okay. Subbu, again, thank you so much. I'm going to turn over to Ghazal to have, I know there are a bunch of questions out there, but before that, one quote from Sir John Templeton. So Sir John Templeton set up what is now called, what was called Templeton Galbraith Hansburger. And then after he sold to Franklin, it became Franklin Templeton. And coincidentally, Hansburger left at Franklin Templeton, set up his own company, Hansburger Global Investors, and we had a partnership with Tom Hansburger from 1997 till 2004, where I got the great opportunity to live in Florida while Subbu was doing all the hard grunt work out of Bombay. If you look at the map of the world, roughly Bombay and Florida are around the same sort of latitude on a global map, but and same weather patterns. But you know, I remember Sir John Templeton's famous words, right? And this is in light of where we are today in markets and in light of previous peak cycles that we've seen. he used to say, there are five very famous words in the world of investing. Four of those words you will hear every time. And those four words are, this time it's different. And the fifth word, which is said under the breath of the speaker, so you can never hear it, is, this time it's different, sucker, right? So with that in mind, we keep the value discipline going. And Ghazal, over to you to help us answer questions. Thank you.
Thank you for that, Ajit and Subbu. It has indeed been a remarkable journey, and we hope this amazing partnership will continue to guide us for the next 25 years and more. On that note, our viewers have sent in a lot of questions for the both of you. So, can we get started with those?
Yes, please.
I'll start with the first question, which is for the both of you. Would you say that investors have managed to increase their wealth over these 25 years following the cue of quantum philosophy?
Well,
Yes, yeah.
I can take that because I actually was looking at some numbers, right, to see how things have moved over the years. So in the past 25 years, right, that Subbu and I worked together at Quantum, and our own track record, which is audited, began from July 31st, 2000 or August 1, 2000. So our own track record is 21 years. And then Quantum AMC, which basically mirrors what we do on the value side for international clients, started, a few years later in 2006, as I said. So based on our own track record for 21 years since 2000, there's been a 32x increase in, if you we gave our investors roughly a 15% plus rate of return compounded after expenses, after fees in dollar terms, and you add about 2.5-3% for the currency. So there's been roughly a 32 times increase over the last 21 years since 2000, even before Quantum Mutual Fund was born, at 18% CAGR. And it's been about 15.5% in USD because the currency has been weak against the Indian rupee, and that gave us a 20 times return. To put this in context, gold increased by 12x at the same time period in the Singh rupee terms. And real estate, I had bought some land in 1994, 95. So assuming that, of course, land varies across the country, but my land increased by 20 times since 1996 till now. And if you bought an apartment, probably about, depending again where you bought it, but 6 to 10 times. So equities as an asset class has done well, better than gold, better than real estate, and seems to be better than land. Again, land is very specific, as is real estate where you buy. But equities has done well, and I think quantum has done even better than the general market indices. And for a value manager, that's a very, very attractive proposition. Of course, with full disclosure and full disclaimers of SEBI, that past performance can never, ever, ever be an indication or promise of what the future will hold.
Your take, please.
So Ajit gave a very long history as to how we have done. So even when I look at quantum long-term equity fund over the last 3 years, 5 years, 7 years, 10 years, the range, the compounded growth at which it has grown is something between 11.5 to around 13%. And that's still a very good number when you look at inflation. That's a very good number, and it is the same process. So Quantum Long-Term Mutual Fund was launched in 2006. So since inception, I think it's around 13.8. But even if I break it down in the last 3 years, 5 years, 7 years, the rates have been something between 11.5 to 13.5. Now, bear in mind, last year, as Ajit had alluded to, that we had a tough time in 2018-19 in value. Now, if you look at that period, the 3-year numbers, 5-year numbers would not have looked very good. So therefore, what it means is, in equities, you need to have a longer term horizon. And definitely, if there is a style, a value style, which can go through its own cycles, you need to have patience. So in 2019, you may have been disappointed, but standing today, when you look back 3 years, 5 years, 7 years, 10 years, I think those numbers are very good. particularly when you look at what the inflation numbers have been in India. It's been quite good.
And just to clarify, I mean, there will be cycles when stock markets forget what style. Like Subbu said, one asset manager, CIO of a large asset manager, told us decades ago, equity as an asset class is dead. And there will be periods of time when you won't make returns. So you can't be an investor in equity mutual funds with a 1 year view or a 3 year view or even a 5 year view. I mean, to me, you got to have 10 years plus view if you want to be in equity. You can't have a shorter term view because even those cycles have crunched in time and they become shorter. A cycle from say pre-COVID to post-COVID has seen a boom, a bust, a boom again. So they become shorter. We saw that even after Lehman, there was a there was a boom pre-Lehman bankruptcy in 2008 September, and by 2009 March, 6 months later, 8 months later, you had the green shoots and the market took off in India after our May 2009 elections. So you will find periods of time when being in equity sounds disastrous and my God, I've lost all this money. But I think if you're sensible about it, equities reflect economic growth. And economic growth comes from companies. It doesn't come from some statistics. Those statistics reflect what companies are doing. And if companies are earning revenues and earning more profits, then their share price over time will be reflected, in the sense in the stock market price, or their profits get reflect the stock market price, and you'll make money. But you have to have a longish term view. It cannot be a 1 year, 3 year, even a 5 year, I think is too short in my view.
Sure. Thanks, Ajit. Um, Moving on to the next question, again for both of you. Is your investment strategy the same as it was 25 years back? What has changed along the way, if at all?
So, you, Ajit, you want to take it?
Sure, I'll go. Yeah, I think what's changed is two things, right? As we began to focus on international institutional clients, uh, they wanted to ensure that our processes were well defined, right? There are 4 P's in our business that are very important. The first P is, who are the people behind this business? What is the philosophy of those individuals or people? The third one is, what are the processes that they have in place to convert their philosophy into an actual product, in our case, a mutual fund scheme? And fourth, what is the not the performance number, but the predictability of the performance? And I think people confuse in the ratings, when you look at the rating stars of 1 and 2 and 5 star, it's highly questionable, because a value fund, for example, is supposed to underperform when markets go crazy. And a value fund is supposed to outperform when markets are in despair or trouble or shock, like we saw post COVID or post Lehman or post Fragile 5 2013 in India. So it's the predictability of the performance, not the actual rate of return number, 1 month, 3 months, 6 months. That's rubbish. You have to know that that process will give you a certain predictability and you can count on it being what it is. And by talking to international investors, and that were, our first large clients came to us in 2005. We were zero AUM when we left Hansburger in 2004. Took us a year to build our team and to get the processes in place, really well defined. And now we have those processes. And what's changed, if at all, what Subbu referred to earlier, is the worry about the global interest rates. So we haven't changed much in the way we look at our companies, but we recognize that there is a cost to capital, and that cost to capital, if you want to call it the hurdle rate of return in some sense, is that FD rate, right? And as that bank deposit rate keeps on declining, as interest rates keep on declining, to some extent, the valuation of a company is sort of the PE ratio is an inverse, in a very simplistic way, is an inverse of the interest rates. So if interest rates are 20, imagine if your FD, fixed deposit, gave you a 20% rate of return, you'd put all your money in FDs, pretty much. And the PE ratio of the market will be, no one will want to buy stocks then. The PE ratio of the market will be inverse of 20. That's 1 over 20, that's 5. And when interest rates, say, go down to 5%, the stock market's PE ratio is the inverse, 1 divided by 5, and that's 20. So that's one thing that's changed in our inputting. at the very, very macro level. I have not done any company research since Infosys, I think, in
Yeah.
2007. So Subbu is much more closer to the research process than I am. But the very broad number to me is that interest rate which Subbu spoke about.
So I'll if Ghazal, if I can add, as Ajit said, these are the macro inputs. But when you look at companies, the company dynamics has also changed over the last few years. The market size has changed. More number of players have come in. So we constantly have to evaluate, do a lot of comparisons between what is happening in India versus what is happening elsewhere in the globe. What kind of businesses are having increasing threats? So those are inputs which we used to track, but in '96 the data was less. We completely relied purely on the annual report and our interactions with the company. But today you have variety of sources from which you can get the data, and then you have to analyze that and see what implications it could have on the company. And those are things which we have been constantly doing in the last few years.
Thanks, Subbu. Thanks, Ajit. Moving on to the next question for you,
If
Subbu.
I may just, sorry, Ajit said,
No.
maybe I have a question, I think, later on coming in. But Ajit said four P's. And Ajit may recollect a few months back, we added a fifth P. So one is the people, the process, the uh, uh, per- uh, predictability, and the philosophy, those four P's. We recently added that you need to also have a uh, I think the word P was for review, periodical review. We see all of this can change. The people can change, the philosophy can change, the predictability can change, the performance can therefore change. So we said we should also add a fifth P, which is periodical review. So every time when we look at a stock, while tick all these four, but then periodically come back and check, does it hold true or not? And that goes to some other question I think you have sent me. We will talk about it a little bit.
So the next question, like I said, for you, the market is at its peak as per your valuation metrics. So are you selling equities now, or is the outlook completely different given that easy money is chasing equities currently?
Uh, See, definitely certain stocks and certain sectors look expensive, and we have been trimming and raising cash. So it's not that we have been selling out completely, but we have definitely been taking advantage of that. So at the same time, we don't think it's an environment where we have to raise a lot of cash by selling out, because we still see some upside in many businesses. So take, for instance, the technology space. The technology space has done extremely well in the last 1 year, and we did book some profits and get out of that. But at the same time, the underlying fundamentals are changing so dramatically in that segment that we are going slow, reviewing it properly, and then deciding whether there is still upside left in that or not. So simple answer, yes, the markets look expensive. Certain stocks, certain segments look expensive, and you need to trim, which we are doing. But at the same time, we do find that what we hold, that there is some good amount of upside left in those.
Yeah, if I could just add a little bit to that, maybe a little longer to that, is that, there's two things you have to recognize, right? Uh, in the last decade or so, right from the Lehman crisis to the introduction of demonetization of notes to GST, ILFS bankruptcy, and of course, pre-COVID world, and now certainly after wave one of COVID last year and the current wave two of COVID, in India and in other parts of the world, there is a dichotomy that all of these actions, some external, some internal, so for example, demonetization is internal, GST is internal, Lehman bankruptcy external, COVID is external. COVID, as we're all saying, is a China virus. But anyway, so, there have been these shocks to the economy. And what's happened over the years, over the decade or so, is that I believe that from a society development perspective, the poor have become poorer and the rich have become richer. And that's true for individuals and even true for companies. So demonetization, GST, COVID wave one, COVID wave two have hurt the ability of smaller companies to survive or even grow their businesses. Whereas larger companies with access to more policymakers, access to banking system credit, etc., have been able to take advantage because as small companies shut down, there is still demand, and that demand shifts to the larger companies. Now, recognize that from a society perspective, the middle class is getting poorer, the poor are getting poorer, the rich are getting richer. But from a stock market perspective, a stock market reflects larger companies. And because these companies are benefiting, generally speaking, from what's happened in this economy, as I just described, you will see larger revenue growth in the listed companies. And because of larger revenue growth, you're likely to see, due to operational leverage, more profits in these companies. And therefore, the share price will go up. So we're entering into an era where listed companies and stock market companies could actually do even better despite the economy from a social perspective being a lot poorer. I'm not talking about GDP growth rate. I'm talking about the distribution of wealth creation in the economy. So, so when you say markets are up, yes, we are concerned about the valuation, but we're also trying to understand what I just explained. That is this the start of a super cycle where you kind of hollow out the economy, you remove the small scale enterprises from the map of industrial India, which is very bad from a job creation or job stability or income stability perspective, but it's great for making money. So we potentially could be entering an era, of such lopsided wealth creation on one side and sort of hollowing out of the economy on the other side.
Sure, Ajit. So, in relation to that, investors want to know what is your view on equities over the next 1 year?
Yeah.
So, like I said, 1 year equity views we don't really have. It's very difficult to say. I'll put it this way: you tell me the interest rate in the US, and I'll give you a sense of where equities will be tomorrow, right? Because as of now, there are two main drivers for equity prices today in India. One is what is the rate of interest in the world in terms of the US Treasury, and all source of money or much source of capital comes out of that interest rate in the US and Europe. And the second is where are we in the waves, right? Where is the vaccination and where are the waves? Are we able to fight the second wave well? And if we come out of lockdown by June 7th or June 15th or June 30th, when we come out of lockdown, will there be a third wave again? Or will the fact that we have, when we're increasing vaccinations, as has been proven in the UK, the more vaccinations you have, the less disruption there is to society and to the economy. So there's a combination of two. And mathematically, we know the vaccinations, right? We know that vaccinations will take a long time. But what we don't know is what the Fed will do in terms of keeping rates low. Janet Yellen, who was like the equivalent of the finance minister, the treasury secretary, she made a statement about 2 weeks ago that inflation is kind of, rearing its ugly head, and the markets corrected immediately. And she had to go back and clarify, no, 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 that's okay. We're going to keep interest rates low. Don't worry. So, if you keep interest rates low in Europe and the US, the bull market can just sort of carry on because we'll have play money that'll come into India. But if you look at the fundamentals, you look at the vaccination policy, you look at the risk of a second wave, a third wave, if you look at the impact of all this on economic activity, if we are still locked at home or not able to move around freely, in general, the economy should be hurt. And when the economy is hurt, in general, stock markets should be going down. But we don't see that today because interest rates are high and there's optimism that we're coming out of the second wave, which is fantastic. But the question we don't know is about the third wave, whether it'll be there or not. So I don't know the 1 year number. You choose a number, and it's as good a guess as mine. And if you're doing it for 1 year, please don't buy equities. You're wasting your time.
Thanks, Ajit. Subbu, the next question for you. How much CAGR can one expect after inflation, considering someone is investing in equities for a period of 2 decades?
So we have a simple arithmetic to that, and historically it has proved to be quite good. So one is you take the real GDP growth rate. So in India, the real GDP growth rate on a very rough basis has been at around 6.5%. You take inflation of around 5 or 5.5%. and you will have a nominal growth in India of roughly 11.5%. If you take inflation at 5, real GDP at 6.5, nominal GDP will be 11.5. So in general, I'm saying in general, corporate revenues will grow at that level, at say 11.5%, because that is the rate at which the GDP has been growing. Listed companies and those which are slightly large, they may probably grow a little higher. That could be, say, roughly around, add another 200 basis points. So it could be around 13.5%. Now, this is just what I'm saying is a blind pool, in the sense it's an index kind of investing. You could probably look at it from that perspective. But if you are an active manager and you choose some good companies which have better metrics in terms of cost controls or better metrics in terms of revenue growth, then probably they could grow at around 15%. Right? So 15% is the kind of expectation. If the top line is growing at around 13.5 to 15, your bottom line could again be growing at 13.5 to 15, and the smarter company would definitely be at the higher range of that. So if you apply that matrix, it has worked very well in the past. We are expecting that India GDP should grow probably at around 6.5 we do percent in the long run, real GDP, and therefore those are the kind of returns we could look at, somewhere between 13.5 to 15% INR returns, if one is looking at 1 or 2 decades of investment.
Thank you, Subbu. Ajit, coming back to you, how can investors benefit from international equity exposure and trading in international platforms through Quantum?
So, I used to when we were partners with Hansburger, I was actually living in Florida and I was the lead manager for a then $2 billion Vanguard International Value Fund. So Subbu and I have tracked companies globally, invested in companies globally, billions of dollars in companies globally, et cetera, on the value side. So in theory, we could create, a value fund and, start, saying, hey, this is going to invest outside India. But the more you look at the developed markets, it becomes more difficult to do that out of India, unless you have a very deep research team, in my view, sitting in the geography where you want to invest, and which means having offices in the U.S. and Europe and China and Hong Kong and Indonesia and wherever else, at least in some of those places. And then you have to say that that team is smarter than the indices. So there's a big difference between the index construction in India and the index construction in the international markets. So although Quantum has launched a Nifty index ETF in 2009, I think it was July, um, I had written to John Bogle. He's no longer alive, sadly. I wrote to John Bogle, the founder of Vanguard. I was making one of my annual trips to meet my old friends at Vanguard and for some other work in the US in February of 2010. And I emailed Mr. Bogle. I said, hey, I'd like to come and talk to you about index. We've launched this index fund in India. I personally don't believe in it. I've not put my money in it. And that's true even today. And I want to talk to you about how it is. So I sent him some data on how the index is constructed. He responded back to me, and I've got that email up here somewhere. But he said, Ajit, if this is the way indices are being created in India, I would not invest in an India index. But I think the way the developed world indices are created and nurtured and monitored are very good. And it's very difficult to find outperformance of an S&P 500 index or of that nature. So if you want international exposure, you may want to buy a passive index in a very well-researched developed market, whereas in a underdeveloped or developing and emerging economy like India, you may want to find that active manager. And there again, there's the view between small cap and large cap, i.e., a small cap company has more opportunities to grow and can give you much higher returns as it makes it up the grade and gets its business right and becomes a large entity in India. So even over there, you can have a risk allocation to sort of yet to be identified big winners in the Indian stock market. But I think it's very difficult to get that, in my view, on the international side. So Quantum thought about it. We've had dialogues with a bunch of people internationally and said, should we be out there launching an international fund? And the best we could figure out was, okay, maybe an index to local investors in India. But there's no value add from us per se on doing that. I mean, Vanguard, the firm I used to work with and firm I used to manage funds for, they've got fantastic indices. So just buy the Vanguard indices and you're fine.
Next question is for you again. When an established and renowned mutual fund house like Franklin Templeton collapses, investors want to know what factors they should keep in mind, when they invest a huge sum of money in a reputed mutual fund house.
So maybe I'll take that. So, SEBI has built a very onerous regulatory structure around the AMC business in India, and starting with the capital. So it's always been my dream since 1990 to set up a mutual fund in India. That was even before SEBI was created and before Indians could set up mutual funds. We could not set up mutual funds prior to 1993 when the rules came out, but always been my desire to do so. So when the rules came out, actually I was helping draft some of the framework for those rules with Dr. Dave, who was the ex-chairman of IDBI, seconded to be the founding chairman of SEBI in some sense, to create the institution SEBI. And I was so disappointed when that committee came up with a 3 crore minimum capital to set up an AMC. The three became five, the five became 10, and then in 2014, the then SEBI chairman, Mr. Sinha, and the committee made it 50 crores. So, we've been chasing that sort of net worth. So SEBI says net worth and high net worth suggests you're a sensible and fit player. They've now changed their mind and they're saying fintechs can now come in, even if they've had losses for the past few years, provided they have 100 crores. So SEBI is still in a mentality of show me money, and if you have money, I'll tick the box and you're good. Of course, I say tick the box loosely, but that's one of the key criteria. Then they have to make and check that you're a fit and proper person, etc. That fit and proper are qualitative aspects. And it goes back to the 4 Ps that we spoke about. Who are the people behind this? What is their philosophy, right? And then, of course, they may have different products or the different processes for a growth fund, for a debt fund, for a multi-asset fund, whatever it may be. And then the predictability of the performance. But the first two, the people and the philosophy, that is what you need to understand. And it's very strange. Franklin Templeton and us, to some extent, we had the same parentage. We both came out of spin offs of Sir John Templeton's entities. We out of Hansburger, they out of the original, which merged with Franklin. And I think somewhere along the Rhine, my father was a very well respected doctor in Bombay. And I used to always ask him, why aren't you growing? Why everyone loves you? Your work is so good. Why don't you expand and, have more things? He converted his one doctor practice where quantum actually began. Our journey was in the doctor's office. We took one room from my father and he set up a polyclinic with multiple doctors. There was a dentist, there was an orthopedian. So, there were multiple doctors there and he would rent them rooms, right, to some extent. So you think about a mutual fund complex with different sort of managers. There's a multi-asset fund and a debt fund and a gold fund and equity. That's what he did. But he never built a hospital because the hospital is really a money-making enterprise. Every time a patient enters and checks in the hospital, the question always asks is, okay, what is my revenue per bed? What is my revenue per testing machine that I've got? The mentality changes. And I think that when we talk about a professional coming into a business, that mentality must not change. And sadly, there's a distance between the people who started something and the practitioners who are building it onward and forward. And so someone has a question, what about the next 25 years? I will most likely not be around for the next 25 years, but I would hate to see quantum compromising on these important P's, the philosophy and the approach that we had as founders of quantum to build something sensible and secure, which people can touch and pinch and say, we believe this. I mean, after I left the boards of Quantum in 2017, we put forth, and it's there on the website of Quantum AMC, something called the Charter of Principles. And the Charter of Principles is an appeal to investors in our fund to ensure that we stick true to what we set out to be and we don't become a profit making machine where products are offered because there's a product because there's a profit opportunity. There's never a harm in making profits, don't get me wrong, but it goes back to that original Mahatma Gandhi picture and the quote that I shared with Subbu, which is the means are as important as the end. We don't want to shortchange an investor to make profits. That's what you need to understand from a fund house. But sadly, of the many, many fund houses that are there today, they're factories. They're not run by professionals who have a philosophy. They're factories trying to extract a share of wallet from your, to convert to their AUM. So you have to figure out, who is most likely to, be a sort of benefit to you and at the least pain to you. And that's why we created quantum as the perfect alternative in some ways. So it's a long answer, but you have to do your homework. So quantum never sells its funds. You have to buy into the quantum philosophy. You have to buy the fund, whether it's to a distributor or whether it's to all the direct, click here buttons that we have on our website. You have to subscribe to our philosophy. You have to buy it. We're unlikely to be sold by distributors because we're not a factory.
Wonderful. Thanks, Ajit, for that. Coming to you, Subbu, how does one choose from the various ELSS tax saving schemes that are, floated around by fund houses? How does one choose an ELSS scheme?
So basically, you have to choose a mutual fund, right? That happens to give you that tax advantage through ELSS. But then to choose a mutual fund, you need to have those four P's which Ajit referred to. You need to look at the people who created it, who are running it, what has been their experience, how many economic cycles they have seen. Then you need to understand their philosophy. Are they looking at growth stocks? Are they looking at value stocks? How do they pick stocks? And then you need to look at the processes. This becomes very important to know as to what kind of research analysts they have. Again, what is their experience? Do they look at the only the growth factors, or do they look at risk first and then look at the returns? You will get a good sense on the process. Many of them actually describe it quite well in the prospectus. But if you also have a chance to meet the company, to meet the distributor through whom you are buying it, and then ask for a meeting, you will get a good sense on the process. And then the three combined will give you a predictability on the performance. How predictable is it? So once you do this homework and then combine it with your own risk appetite, your own long term goals, it will become much easier to choose the kind of mutual fund which suits you. Like for instance, if a mutual fund is giving brilliant returns in 1 year, at the same time it is down significantly the next year, to me personally that is not suitable because I don't like huge volatility. So I will choose one which has less volatility. So you understand these four P's, and then, as I said, you periodically review it and see whether the four P's still work or not. Based on that, then you can choose the mutual fund. It could be an ELSS or it could be a non-ELSS. But these are the four minimum criteria you should choose or look at before you choose a mutual
So Quantum does not invest in companies which have a volume below a certain threshold. First of all, what is that threshold and how is that threshold or limit decided?
So some time back, Ajit had referred to the capacity of a fund, right? What is the capacity of a fund? So when we launched the mutual fund, we said, let's assume that we will manage $1 billion, right? At that time. So $1 billion and a minimum investment in any company we do is 2%. So 2% of $1 billion. So pardon me for saying everything in dollars. I'm just used to that metrics, but we will convert it into rupees in the end. So 2% of $1 billion, that's like $20 million. And our holding period, if you look at the past track record, generally has been around 5 years. That's like 60 months. And if you take 5% of that 60 months as the period when we will either buy into the stock or get out of the stock, that works out to roughly around 66 days or 3 months or 66 days, 66 trading days. So this $20 million you divide by the 66 trading days, you will roughly get around, I think, 300,000 or 333,000. as a trading volume which you will require to fulfill that position within that criteria. Now, you can't be 100% of the market. So, if you assume that you are 30% of the market and you divide that $300,000 by 30%, you will roughly get around $0.9 million or close to $1 million. That, if you convert it into rupees, it works out to 74 million rupees or 7.4 crores. So that's the metrics. You start with how much you want to manage, what is your minimum investment, how much time does it take to buy into that stock. And the reason you have to take that into account is if you are very aggressive in buying or very aggressive in selling, it can have an impact on the prices. So you want the NAV to be real, right? You don't want the prices to move up significantly when you are buying or decline significantly when you are selling. So based on that metrics, you come up with this number that which in our case happens to be around 7 crores. Now you are right that there will be companies which are trading at less than 7 crores. They could be high quality companies, high growth companies, but we are stating it upfront. We will invest only in companies where the trading volume is good and where we find value. So we know that these kind of companies, while they are attractive, is not suitable for this product which we have. So we will have to miss the initial phase. But we also think at subsequent times when we buy into these companies, even though they have become larger in terms of market cap, there could still be value. There could still be a lot of returns to be generated in them. So we may be late, but we could still buy these companies at a later point in time.
I'll just throw one thing. The reason we chose $1 billion and not 100 million was, look, if you have $1 billion under management and roughly on the equity side, and roughly if you're charging a 0.75% or a 1% fee, so then you have a certain revenue idea of what you're going to have. And then you also know what your costing is. So people may not realize this, but Quantum has Quantum AMC and Quantum Advisors, the sponsor. We have a mini law office in our company. We have over a dozen people on compliance and legal side, making sure that we fill in letter of law and spirit of law. We comply with regulations in the US, in Canada, in Europe, and of course, certainly in India with SEBI. So, there's a large team of people that we have in addition to the fund managers and the research analysts. The other, I think, unusual thing about Quantum for years was that for many, many years, we had the largest research team in India, despite our relatively small AUM in the early days. And that was because, again, Tom Hansburger's teaching that you must have databases built in-house, not the raw data, but the value add to the data. You must own the data and you must own the customer, hence direct to investor. So because of that, we have to have a fairly, fairly large team. If we were, just me and Subbu managing money and using the sell side brokerage recommendations to buy and sell and trade and whatever they tell us to do on a regular basis, we would not need $1 billion of AUM. But if you have a large team, you have to ensure that the team are paid, very fairly over long-term horizons. So that's why we began with $1 billion in the first instance.
Thanks, Ajit. Subbu, the next question is for you as well. Most of the stocks in the portfolio are old economy stocks. Why is the fund not looking to invest in new upcoming sectors?
Ghazal, we do research on all the sectors, whether it's upcoming or whether it is old. Our job is to continuously monitor and look at every company from different sectors, which meet our criteria in terms of trading volume and in terms of valuation. So when we look at some of the new sectors, and when I say new sectors, it could start from, say, the retail business in India, which has been relatively new. You look at, say, the quick service restaurants, QSR companies, or you could look at, say, some of the companies which use only the internet to do business, right? These are some of the new age companies, but the valuations in these companies are pretty expensive. And we are value managers, so even though they look attractive, they look that they will grow, but there are risks involved in that, right? So we don't want to pay a lot of money to buy into the stock, in the sense that we don't want to buy it at a very high price to earnings ratio or a very high price to book ratio. And most of these new age economic companies trade at very high multiples. So as a value manager, therefore, I don't have a choice. While I track it, I can't buy it till it comes to a attractive valuation. So therefore, the portfolio continues to have some of the old names. Now, just because it has old names doesn't mean that these companies are not adopting to new ways of doing business. I'll give you an example. We have one motorcycle company in our portfolio, which did an entire launch last year of a new product through digital means. Right? You know that there was a lockdown. You know that shops were closed and dealerships were closed for 2 months. But this company managed to launch a product purely using a digital means of communicating. So old companies also use new methods, and but they are attractive. They are attractively priced, and we hold them. And but some of the new companies we would like to buy, but the valuations are very daunting. So that's the reason we don't have that.
Ajit, one of our investors has noted that Quantum has covered almost all bases and given a variety of plans and funds that meet almost all needs of a conservative investor. However, there is no plan that gives a reasonably assured monthly income, for those approaching retirement age or those who are retired. What are your comments on this?
So, yes, we do have this very simple, answer for most investors that if you just follow what we call the 12-80-20 rule, where you keep 12 months of your monthly expenditure. So if you spending 10,000 rupees a month, so you say 12 times that 1.2 lakhs between your savings bank account and the liquid fund, you keep that money aside and the rest goes, 80-20, 80% in equity and 20% in the gold ETF. And of that 80% in equity, you give a significant chunk of that, 75% of that, which goes to the equity fund of funds. And then you have the India ESG fund and the long-term value fund. So that to us is the answer. I mean, in some sense, right? That's what you should be doing and what you should be, where you should be allocating money as opposed to trying to do anything else. So I don't know if that kind of sort of answers your question, or you could you just repeat that again, so in case I may have lost my train of thought. Sorry.
Monthly.
So, a product that addresses the needs of those who are
Yeah.
retired or approaching
So
retirement.
okay, so, yeah, sorry. So this takes care of your long-term needs, right? That you have this long-term desire to grow capital and preserve money for periods like COVID, when you have that 12 rupees or 12 or 12 months of money that is accessible. So this monthly income thing is the only thing which I know of which exists, where we'll get a definite return every month, a guaranteed return every month, is effectively an FD. You can take a quarterly FD, annual FD, monthly FD. You can take a savings account where you'll get certain interest, etc., etc. But when a mutual fund is giving you a monthly payout, it's really paying you your own money back. It's not, generating something in the sense that if you want to create your own monthly income from, say, the quantum mutual fund, long-term equity value fund, or equity fund of fund, or India ESG fund bucket, what you need to do is just write yourself a redemption reminder note in your diary. Like I have this diary from my old days. Just sort of write it in your diary that every month I'm going to take out some sort of money, and you'll be fine. That's all you really need to do. So the fund house giving you something, it's really giving it to you from your gains which they're paying out. The only other way to do it is by having a liquid fund or having a bank account. There's no other way to create this magical, fixed known monthly number. And just to me, it's like just the equity managers are giving you back your money as opposed to you getting the redemption. They're deciding the redemption for you. That's the only difference.
Sure, Ajit. Um, the next question again for you, Ajit. In developed markets, the investing trend has been moving from mutual funds to index investing, and our investors want to know your views on that.
On index investing, okay. Well, I shared some of my views. We have an index fund that we launched in July 2009. Uh, we believe that at some point in time in the future, the Indian economy will mature. Active managers like us and like so many other fund managers out there, active managers won't be able to source or identify undervalued securities, whether it's a growth style or the multi-cap style or the small cap style or the mid-cap style or the value style. At some point in time, the indices will capture everything, right? And they pretty much capture everything in the developed world. They don't capture everything today. And a very simple statistic is to just look at a pattern. I think we have that in one of our past presentations over the year. Look at the pattern in terms of number of stocks that are being changed in the index every year, whether it's the NSE 50 index, whether it's the BSE 30 or the BSE 200, and compare this to the number of stocks that are changed in the Dow Jones index or the S&P index, or in the more developed market world indices, and you'll find a sharp contrast. You'll find that the Indian indices are being changed on a very, very regular basis, which is why John Bogle, the founder and father of investing, sadly no longer alive, but his email lives immortal in my heart, that said, this is not the right time and this is not the right index to mimic in an ETF or an index fund. At some point in time, the index providers will get it right and the economy will mature and not throw you startling new enterprise where you can make money. But that's still some time away. When it's ready, we will certainly tell our clients that, look, take your money out of the value fund or the equity fund or the India ASG fund, just buy the Quantum Nifty index. It's there since 2009 July. Its capacity is thousands and thousands of crores. So there's not an issue. We built a track record, we built a vehicle. We just don't think it's the right time to do that. So I did a webinar for personal FN on this passive versus active investing a couple of months back, where I showed John Bogle's email, I showed his text, I showed this description. So, to me, index investing is very sweet and very cute, but to me, there are still opportunities, whether it's value, whether it's growth, whether it's ESG, whether it's small cap, whether it's mid cap. That's for you to decide what risk you want and which manager or which fund you want to invest in. But I would stay with passive. I can tell you with great confidence, I don't have a single rupee in our own Quantum Nifty index fund. Not because the fund manager is a bad guy, he's a super guy, but I don't really believe there's necessary to invest my personal money in that fund at this point in time.
Thanks, Ajit. Either or both of you can take the next question. What is one missed opportunity or misstep you wish never occurred?
You want to start to?
You can take this one. No, there are many. So I have many. We have a history of missed opportunities, right from things we sold too early to things to things we should have bought earlier or should never have bought. Okay, maybe I'll take Yes Bank. I mean, I was not, but Yes Bank. We waited. We liked the concept of private banking, right? In some sense. So I'm talking about the stock now, not of the business. So we like the concept that private sector banks have going to take market share from PSU banks. That's kind of a given. And we already owned some of the private sector financial institutions. And obviously the price of Yes Bank was too high. We were not very happy with the quality of the book, et cetera, et cetera. So when it transpired that the previous founder, Mr. Kapoor, had to leave the bank and RBI nominated someone on the bank board, we said this is a catalyst, right? We look for catalyst. What makes you excited about something which you're really not so excited about, or the other way around? So we looked for catalysts. And our catalyst was, okay, RBI has come in. They've got a professional guy to run the business, picked up someone from Deutsche Bank to come and run the business CEO. And, they'll raise capital and they'll clean up the books. And, we saw that phenomenal jump in the share price of Yes Bank after it's collapsed at the last quarter of 2018 it was, right? So if I get the year right?
2018.
It was 2018.
Yeah, 2018.
And by February, March of 2019, we were like 40, 50% up from our investment in Yes Bank. And it was, absolutely fantastic. That was very, very good. And then what happened after that, of course, is, history and legendary, is that the bank made a very strange statement. I mean, everyone knew that the bank had a problem on the balance sheet. No one knew how much of the balance sheet was genuine or what was bad loans. Forget the genuine part, but bad loans. And everyone knew the bank had to raise more money. And when the CEO and the management of the bank made a statement, I think it was April of 2019 or thereabouts, where they said, actually, was it April 2020? I forget now.
To
The COVID has
2019.
wiped out years. Huh? April
2019.
2020. No, sir,
19.
April 2019. They made a statement which was very strange, which said that, we don't know how much problem there is in the balance sheet, and we don't quite know how we're going to raise money. We're like thinking, really? You got RBI on the board, you got a new CEO. That's the problem you're supposed to solve. You're meant to figure out what's the problem in the balance sheet, and you're meant to figure out where to get the money from. And then now you're telling us after 6, 7 months that you don't really know. That was really shocking, and we kind of sold out, obviously at a huge loss in that, after making a notional profit, which we never encountered. But there are many. We could write a book on all the silly mistakes we made in our history, and it'll be a longer book than the ones where you can say, aha, I made some phenomenal gains. So, end of the day, in our business, you have to make sure that you have more money lying in your gains and your winners, and less money lying in your losers. So we had a little bit of money in Yes Bank, and we had more money in the financials that made us money. So it's not the amount of stocks you get right, it's the weight or the allocation of capital of your 100 in a mutual fund that you have to get right. If we had a lot of money in Yes Bank and a lot less money in the losers, sorry, in the winners, we'd be in trouble. So it's not only the number of stocks that you get right or wrong, but it's also the weight that you have in those stocks that you get right, and the weight or exposure that you have in the stocks that you get wrong.
If I may just add over here, Ajit, I actually thought you were referring to another statement, but this statement was made in April 2020. By March,
Oh,
we were
April
just
2020,
getting
yeah,
out. Yeah,
correct. Sorry, yeah, it was
somewhere
just what you,
March
yeah,
or April
yeah,
2020.
yeah.
So if I may add, one is of course stock-wise, there have been many. We had a investment in a company called 3i Infotech many years ago, very attractively priced. We bought into that. The company then became very aggressive and made a lot of acquisitions by leveraging. And none of those acquisitions really paid off. And we were patiently waiting that they will be able to clean up the books. And that did not happen. So we had a terrible loss in 3i Infotech. And that's when we actually put in a lot of process changes. We said that once we buy a stock, and if it is down by 20%, X number of fund managers will go and visit them. And if it is down even further, then two out of the four fund managers will go and visit and try to update and understand what's happening in the company. So those kind of changes we made in the processes subsequent to 3i Infotech. Similarly, when I look back in 2008, probably we were too early in selling out certain stocks. In 2008, if you know the global financial crisis, stocks like Tata Motors actually had come down to very attractive levels. And they also had the small car problem. So we sold out at that time, thinking that this problem will continue for long. And subsequently, of course, Tata Motors, for a variety of other reasons, went up very, very significantly. But from a business side, Ajit, if I may just share, if I look back at our own success, touchwood, we have had a stable team over many years. Even in the past, we had a stable team, and we had a lot of women in our team as well as analysts, right? Which we thought would eventually also become they will become fund managers. Then, of course, for again their own personal reasons, right from marriage to other issues, many of these women left. Now, of course, we have smart people like Ghazal and Sneha being in the team. But I just wish that we were able to retain a few of them. And on the equity side, which is a very male dominant team right now, we could have had the benefit of also having women in the team. So if I look at from a business wise, probably the team structure could have been a more satisfactory team structure.
Yeah, it always saddens me. Recently we also lost Atul Kumar, who was a long-standing fund manager at Quantum Long-Term Equity Value Fund. And it's always saddens me personally, and I'm sure Subbu too, when we lose a colleague or a partner along the way. But you know that when you start a journey together, not everyone will be there for the length of the journey for their own reasons and dynamic stuff. So it always saddens us when we lose people who were very good. And yeah, we did lose a lot of women because they got married, or their in-laws said they could not work anymore, or they felt they should not work anymore, or they got married and they had to relocate countries. We even tried to do that. Remember Singapore,
Yes.
Subbu?
Yeah.
We had a very smart lady with us. She got married, went to Singapore with her husband. We took approvals from the regular. Those days, work from home was not popular. It was very difficult to convince clients and a regulator that you can sit in another country, forget in their own city, in your home, but in another country, and that we will give you the same compliance standards as someone coming into our office. This was which year? 2009, 10, 11, I forget. A long time ago. It was like a decade ago
I
that we
think must
did
be
it,
around
where
10,
she moved to
2010
Singapore. And
probably. Yeah.
yeah, and we said,
2010.
we will create the office structure for you in Singapore, like work from home out there. So we absolutely, end of the day, as we said, it's about the people and the philosophy, right? The way we build Quantum is just like a partnership, and we'd love for people to, Subbu and I would love to train people and watch them blossom and take them a significant, sort of share of the revenues and the profits that come along the way. That's the whole idea, to make it sustainable beyond just an individual or beyond two people. So the outlook for the next 25 years is that Subbu and I will not be around. Just kind of mathematically, our age is our age, and we're not going to be around to be actively picking stocks and going out there. So we have to have a next generation do it, and be there to look after your wealth and your allocation to India, to the Indian equity markets and fixed income and gold.
All right. Thank you. Moving to the next question now. So, with interest rates at such lows and ample liquidity chasing risk assets, can we really classify stocks as value now because of sheer PE expansion?
I think as I explained a couple of questions before this, and where Ajit also explained, yes, certain segments, certain stocks look expensive, but the environment is very rapidly changing in the post-pandemic world. Even right from 2016, when we had demonetization, GST, the larger companies are becoming even larger and better, and that theme has is playing out even more in this COVID situation, where a lot of small companies are actually not able to compete or be in business, and they are losing out. So if we get more data and it is very clear that larger companies will probably have higher market share, then that EPS which number which we are looking at currently may be understated. In which case there might be upgrades and the market or the stock may not look very expensive. I wouldn't say that we are at a situation where there are a lot of value stocks available, but at the same time, I don't find a reason why we should sell out of many stocks. There is still upside in many segments. Even when we look at the financials, the upside in many of the financials is quite attractive. So we are somewhere in that sweet spot, not able to buy a lot of new stocks, but don't find the necessity to sell out of existing stocks.
All
You know,
right. Either of you can take the next question. Why does Quantum not have a mid cap or small cap offering?
Was it for me, Ghazal?
Yes, yes,
Yeah,
Subbu.
no, we have been tracking the mid cap for the last 1 year, I would say, more seriously. While we had analyzed the mid cap earlier, we did not have a team. But in the last 1 year, we have built the database. We have two people now looking at the mid cap space, and the data is quite robust. So we are working on the process by which we will invest. So there is a process of doing research and there is a process of doing portfolio construction. So when we look at the portfolio constructions, we still have some challenges which need to be addressed. So once we do that, then when we find that there are, yes, attractive names for us to buy into, and we could also put our own money into such a product, then we will offer it to the retail investors.
So if I can just expand on that a bit, Kazal, I think the important thing is process, right? So it's easy to launch a small cap and mid cap fund. The key question is, does Quantum have a skill set, the secret sauce, to identify those small and mid cap funds on a recurring, repeatable basis? Right? Because eventually a small cap, mid cap fund will get, there'll be a large companies in it and they will graduate and they'll have to exit the portfolio. Then you have to find the next small cap and mid cap stock to fit into the definition of a small cap, mid cap fund. So what is that process? And, we're not smart enough or haven't been smart enough so far to identify that process that we can showcase to investors and say, hey, this is it. It's tried and tested. One thing which many investors will know about Quantum is that we don't launch our funds with a lot of fanfare. We do a lot of work in-house, a lot of back testing, a lot of model accumulation, a lot of data collection, a lot of hard work goes in. And then we do a gentle launch and it's out there. It's a real product. Take the case of the Quantum India ESG fund. We launched it in July 2019. But it's behind the Quantum India ESG fund is from 1996 till 2014. We've had this integrity screen, which effectively prevents us from buying a Vedanta or a SR or a Reliance in the portfolio. It prevents us because those companies don't, they may be very smart business people and very successful, but they fail certain criteria which we have. And of course, beauty and those criteria lie in the eyes of the beholder. They may fit, some other fund house may think they comply with those criteria of theirs. But after that integrity screen, we built around on it this ESG framework from 2015 till 2019. So you've had a history of 1996 till 2014. You've had 18 years of history, if my math is still right over there. And then you've had 5 years or 4.5 years of further database building. So after 19, 20 years of understanding certain metrics, we launched the Q India ESG fund. That's why it's, and of course, now ESG is hot. Everyone's talking about it. People are launching funds, distributing lead funds. We have a product. It's been there. It's tried and tested. The process is known. We believe that it's repeatable. The performance or the predictability of the performance is kind of known. And that's why now we talk about it because it's been through a cycle. It was launched in July 2019. Markets ran up substantially till a peak in 2020. They collapsed after COVID and they've come back to the peak. So it's been through the cycle and it's been, gritted and tested and banged on and everything. And it's done very, very well. That's a great product to also look at. So we have to have the process in place. No process, no discussion of bringing it to the client and investors.
The next question is for you, Ajit. This investor wants to know more about the Quantum Multi-Asset Fund of Fund. He says it's a unique fund offering and he's curious about what thought process went into its making.
So two things. Let me talk about two of these. One is the equity fund of funds, right? If you're not sure of the hundreds of funds out there, which one to buy, we said, okay, we will help you. Keep in mind that we're that professional doctor. We're Dr. Dayal, GP at J Mahal Churchgate in A Road Street. And we're telling you that, okay, if we don't know how to do something, I'm a GP, go and meet this guy. He's a specialist. He's the guy to discuss your asthma, your whatever problem you may have. So we built this equity fund of funds, saying, look, you trust us. And now we are on your behalf figuring out which of those hundreds funds out there actually are worth your allocation, worth your money, worth your capital. We built the equity fund of fund for that. And also we're telling you that give most of your money there. So the fees don't even come to us. Much of the fees go to them, to the people where the underlying funds are managed. And I think we charge 0.25% or something as our fee for doing all this, for wrapping it all together, for doing the research and updating it. And then we tell you, add the plug on of the equity of the India ESG fund, and the value fund. Similarly, on the multi-asset side, if you're very confused about what you should do, about where to allocate money, how much to put in equity, and this 12, 80, 20, you still don't want to do that simple calculation and don't want to monitor, so you know what? Give the money to the multi-asset fund manager. And the multi-asset fund manager will decide across three asset classes of equity, of fixed income, and gold. And they will decide depending on their own criteria. Again, that's got nearly now, I think, a 10-year track record, if I'm not mistaken, in that multi-asset fund. It's again been through cycles and it's done pretty well. The multi-asset fund or any investment should be benchmarked against an FD rate. A fixed deposit rate, to a large extent, is a risk-free rate that you as an individual investor can access. And that risk-free rate of State Bank of India FD has been inching down. And the key for the multi-asset fund is, again, it's got equity in it. So if I have a 3-year plus horizon because of the equity composition or part of that in the multi-asset fund, minimum 3 years, what is my 3-year FD rate? What is my 1-year FD rate? And if I look at the track record of the multi-asset fund over the near decade that has been in existence, how many days in this 9 or 10 years has it outperformed the passive investment in an FD? But keep in mind, we invest for future consumption. We invest to ensure that whatever our basket of consumption today or our needs for the future are, that we can afford it. We don't invest, at least certainly from a quantum perspective, we don't invest to prove that we're smart or that we're dumb. We're just proving that we can do better than an FD rate and beat inflation and give you the purchasing power and capital appreciation required over decades in the future for your children's education, new home, whatever it may be. And the risk-free rate has to be that comparison. So the multi-asset fund, if I again remember the numbers correctly, 85 or 90% of the time has outperformed an FD rate which you would have got if the money was parked there. And that's what you need to do. So if you don't really know what to do, if 12, 80, 20, even the simple formula of 12 months money lying in liquid fund or bank account and 80% of the balance lying in equity funds, those three I mentioned, equity fund of funds in India, ESG fund and long-term value fund, and the 20% balance lying in gold, if that is too difficult for you to monitor, just buy the multi-asset fund and sort of forget about it if you have a 3, 4, 5-year view. And you will have a sensible rate of return compared to a State Bank of India FD or any bank's FD, and you'll see appreciation over above that. So, we're doing things to make it simpler, to make it easier. Why did my father have a polyclinic? He said, okay, these are good doctors. They're good in their specialty. If you come to meet me as a GP, cross the hallway and you can meet this guy for your dental treatment, this guy for your orthopedics problems, whatever they are. So this very similar way, we don't have that expertise. So we built the equity fund of funds. You don't have the inclination or the time to look at a simple 12, 80, 20 structure. We built a multi-asset fund for you.
Thanks, Ajit. So, is there other plans to replicate the fund of fund model for debt funds as well? An investor wants to know.
I'm sorry, I missed that question. Sorry.
Are there plans to replicate the fund of fund model for debt funds as well?
Debt funds as well. So we have a fantastic debt team, right? Arvind joined us in 2004 to build out again research databases on debt, fixed income, and then build out the fixed income product. And now we've got Pankaj who's managing the sort of the dynamic bond fund and the liquid fund at Quantum AMC. So we have a fabulously smart debt team. The problem with debt per se is that the spreads, the rate of return that you get over and above the government riskless, highly safe bond is minuscule. And it's really not worth the time and effort for a retail investor to look at, in our view, debt funds. These, in our view, are institutional products. I'm not counting about the liquid fund now. The liquid fund is where you park your money for quick access, not for returns, but for safety and quick access. And as a Franklin Templeton problem last year and of other fund houses stress showed that the liquid fund which invests only in government securities gives you all the safety you need. It may not give you returns, but you don't care about returns, you want safety. But in a debt fund, you want to outperform something. So the dynamic bond fund has done fabulously well since inception and done very well over the last 2 years as interest rates have been coming down. But for a retail investor to be in a debt fund, they have to track the movement of interest rates, right? Because debt funds work on the returns from a debt fund come from two things. One is the coupon. So if you buy a Government of India bond and it's giving you 6% and you stay with it, then fine, you'll get that 6% coupon interest every year in the fund. But it also is influenced, the return is influenced by the interest rate in the market. If you buy a Government of India bond, you know, now, and it's giving you say a 5% return, and you put 100 rupees in it, if God forbid, after 1 year, the interest rates rise to 10%, your 100 rupees that you paid for the bond today will fall to 50 rupees because now the interest rate is 10%. So you have to equate that bond effectively to the new interest rate. So in a theoretical way, you're taking the risk of interest rate movement, not only the coupon that you collect. Now, unless you're a corporate treasurer sitting with thousands of crores of extra surplus and you're trying to figure out how to earn more money and sharpen and maximize your rate of return for your P&L and balance sheet, it's really not your worth, in our view, not what you're worth your time and effort to worry about a debt fund of funds or any debt fund. Again, I do not want to take away the brilliance of Pankaj and Arvind in building what they've done, but it's really for institutional investors on the debt side and for liquid fund for everyone. Every retail investor, in my view, must have an allocation to a liquid fund for easy access to money in times of COVID or worrying about whether your FD will actually be returned to you on year 3 and year 2, because even the banks, as we know, have had certain issues over the last few years.
Thank you, Ajit. Subbu, how should an investor tackle periods of negative mutual fund returns?
So, of course, it depends on the kind of fund which you have invested in, whether it's equity or debt. But in equities, I would suggest that if your term horizon in which you wanted to invest is still quite long, then depending on the levels at which the negative returns have been generated, or depending on the size of the negative returns, you could think of adding more and averaging it out. As long as your risk appetite and the philosophy of the fund match, you can take advantage of that and remain invested. On the other hand, if you have done an SIP, then you would automatically get the advantage of the decline, because every time the mutual fund declines, your SIP would get more number of units in the same fund, and that will help you average it out. So if you have a long-term horizon in this equity, I wouldn't encourage you to get worried about the negative returns and sell out. You should sell out only if your philosophy does not match anymore with the fund's philosophy, or if your near-term goals have been achieved and you want to reduce your exposure to equities, then you can do that. Otherwise, just because of market action, if there has been a temporary negative returns, I don't think you should get out. You should take advantage of that. So, for example, one could just go back and look at last March, right? The March, these markets declined. Most mutual funds, NAVs would have declined. Now, if you had just taken a view that this near-term negative returns is something which is not bearable, while you still have a long-term goals, and you went ahead and got out of the mutual fund, you would have got out at the most terrible time in its recent performance, right? So therefore, you at any point in time, just reevaluate why have you invested, what have you invested for, and if there has been no change, take advantage of it by averaging or just staying where you are at that point in time.
Subbu, really,
Sorry, can I just make another,
yes, Ajit.
to just add to what Subbu said, which is accurate, is just, referring to a previous point that I was made, that it's not about, investing is not about boasting with your friends that you had a higher return than they did, or whatever it is. It's about trying to achieve a goal that you have in mind. And people forget that. there is a time in life when you get off a train and say, okay, I've reached my destination, that's it. So I see a question on the box. Someone is saying that, hey, I'm 65 years old. What should I be doing? Now, if we knew more about that person, for example, if you're 65 years old and if the money you have is for your grandchildren, you don't need that money. I would say, hey, you know what? Follow a 24-80-20 rule. Keep aside money for 24 months of your expenditures, and the rest of it put 80% in equity and 20% gold, and that'll go to the grandchildren. Your 24 months is a cushion in case there's a COVID like scenario. You have that emergency fund. Because you're 65, you can't get a job, you can't have incomes, so you'll keep that long cushion. So in case equities collapse, there's some time for a recovery, right? So a lot of it depends on what your destination is. There can be certain grandparents, for example, who want to leave all their money for grandchildren, and they really don't need much for themselves. So maybe they have even a less emergency fund, and maybe only 6 months or 9 months, and they keep the rest of the money, 80-20 in equity for a long time. Or people are still earning a decent pension because their corporate pension, very rare, would have been rich and can sort of, take care of all their day-to-day, month-to-month expenditures. Then you don't have to have a large emergency fund, because you can let the rest of the money ride for your grandchildren's sake, because it's a long-term horizon. So a lot of the decisions that we make on where to invest and how to react to market movements, you must always keep in mind what is your objective, what is your destination. You're not trying to prove a point that I'm the smartest punter. Then don't be in mutual funds. Go and buy stocks and try to figure out which stocks are moving on a day-to-day basis. Like I saw yesterday, $280 billion of equity, of index options being traded in a day. Like, wow. I mean, then you start doing that, doing that punting. This is for long term. This is for trying to achieve long term goals, not for trying to hit the lottery.
Ajit, a related question. The investor says that in the financial media today, some experts obviously are recommending to invest for the long term, and some suggest booking profits at these levels. So, isn't this contradictory and confusing for investors?
So, should I just, what I do with my personal portfolio, I try to follow a 24-80-20 rule. And I do this for even for my family, for my sister and my brother, etc. And, looking at their needs again. So a bit of musty you can do, So I have bands around that 80-20, plus 5%, plus 10%. So you take a bit of musty. So at the start of the year, if I know what my expenditures are likely to be over the next 12 months or 18 months or 24 months, I'm happy to take some money off the table and book profits, as we call it, and move it to the liquid fund and let my emergency, money get replenished, because obviously I'm using that every month in some sense to pay bills. So to replenish it. So again, I do it more with objective. And yes, there will be points in time when markets give you phenomenal opportunities, as they did post Lehman, as they did, now post first wave of COVID last year. The markets give you great opportunities to buy in. So you may have an SIP of 10,000 rupees a month for yourself, 5,000 rupees a month for the children, and that's been going on for years. And when you see that market opportunity, I would actually add more into that fund. I would say, okay, let that 5,000 rupees keep on going every month, or 10,000 rupees a month, but I'm going to put 50,000. I'm going to put 1 lakh. I'm going to make a one-time lump sum investment in addition to to what I'm putting in. In a very similar way, if markets tend to be up and tend to be frothy or tend to look expensive, I would let my SIP continue, but I would probably, on a tax efficient basis, harvest some of my older investments where the tax rate and the tax pain on me would be less. So yes, it is absolutely fine to harvest a bit and to add some more, but it's ridiculous in my view to be out of an asset class. Because like Subbu said, and as data has shown in previous webinars that Chirag and others have run at Quantum, you don't know which asset class is going to do well in any calendar year. It could be fixed income, it could be equity, it could be gold. And you should, as a lay person, as someone who's not sitting by an NSA screen or a BSC screen 24/7, you should not, act to headlines. You should behave very rationally and take advantage of market situations for sure, but don't let prices rule your emotion to say, oh, market's at a new peak, I better get out. There's going to be a COVID third peak, I better get out. Or, vaccinations will take a long time. Sorry, other way around, vaccinations are going to start tomorrow and we'll be having great vaccinations. So I better, sort of dump in a lot of money. Be rational about what you do and be disciplined. You have your own process, like we have a process.
I'll just add a point here, Ghazal, out of my own experience over the many years. Equity is such an asset class where there are going to be tons of views. For the same level, one could say book profits, the other could say you enter at these levels, right? So, therefore, looking at what the media says is not the right answer. You have to do your homework. And Ajit gave a good explanation, your own homework in terms of your needs for the near term versus your goals for the long term, and then decide whether you want to book profits or reduce your exposure or increase your exposure. Watching media and deciding can be very, very confusing because there is no standard definition of long term.
Yeah.
For somebody who is 75, the long term could be very different from somebody who is at 60, right? So you have to judge on your own as to what's your time horizon and then decide accordingly.
Yeah, and if I can just sort of add to that, I mean there was a question earlier on that I just saw sort of crop up, like can you give a tabulated return of short-term, long-term returns? Think of the risk return grid, right? It's a lean, so on one side at the bottom axis, if you will, at the x-axis, you have effectively risk level, and on the vertical axis, the y-axis, you've got returns. So looking at it in some sense, if you are at the bottom left quadrant, low risk, you will get low return. That's your liquid fund. So if you want something near term, long term, no matter what your terminology is, our time horizon, you're going to get 3, 4, 5, 6% at the liquid fund. That's it. Not going to get anything more. You're not going to get 20% and 35%. Liquid fund is liquid fund. It invests in government securities. Interest rates are what they are. And the next level up, in some sense, would be gold. It's kind of in between, that and the equity. On the extreme right is equity. Let's take equity second. Equity, as we know, is highly risky, right? Risk is not only the volatility, which is an up and down movement of price. Risk is actually companies going bankrupt. Yes, bank, right? Risk is companies not giving the returns that you want. They fail, or economies being in trouble and company earnings not being good, then stock markets fall. So there's high risk in that sense. And you should demand a higher return because you've taken more risk. And that rate of return we've seen from the BSE 30 since 1979 equal to 100 is about 19%, depending which time you end at, 19% per year compounded. Year after year after year is what you've earned from equity. And as Subbu said earlier, chances are in the future, you'll probably be closer to 15% on that. So you've got 15% at the equity level, and you've got 3, 4, 5% at the liquid level. Different levels of risk, but those are the returns. And in between that, you've got gold. And in between gold and the equity, you have effectively the multi-asset fund, which is a combination of all these. So multi-asset funds, to answer another question that came on the chat group, why is a quantum multi-asset fund lagging on a 1-year basis or a 3-year basis? Please look at the track record of quantum multi-asset fund between a very specific time horizon for you to understand what it's about, between January 2020 and say April or May of 2020 when COVID hit. Multi-asset is supposed to, by definition, be multi-asset. It's meant to be across different asset classes. And the quantum multi-asset fund has a very defined framework of where it will invest. Other fund houses have followed a different criteria. Their risks may be different. They may have higher equity. When they get walloped by COVID first wave, the multi-asset funds or balanced funds, as they call them, they were quite unbalanced and they had all equity or large equity, and they collapsed in NAV. And then, of course, equities have done very well. So they've now done extremely well, but they're not balanced as much. But for you to decide whether you want a balanced fund that is tending more towards equity, or you want a multi-asset fund, as I explained in this grid is looking at giving you a 7, 8, 9% rate of return, or has given that in the past, and potentially could do something like that in the future. and it's got a sensible allocation across different asset classes. That's for you to judge your level of risk and then choose the right fund and the right fund house accordingly.
Thank you, Ajit. Next questions for you again. What is the future of gold as an asset class?
So I'm a gold bug. I must confess that, right? I believe in gold a lot. The more, even though I've studied MBA and I'm not a CFA, like Subbu's a smart guy. He's done the CFA. I've not done the CFA. I'll fail if I was to the CFA. Um, so I look at gold as a currency, right? It's maybe in solid form, it may be in a brick form, and it may be, it may have a color golden, but to me, it's a currency. And if I look at what President Nixon did in August 15th, India's Independence Day, coincidentally, August 15th of 1971, I was only 11 years old then, so I did not read about this then. But President Nixon took the US dollar off the gold standard. And by taking it off the gold standard, he allowed central banks in the US, the Fed, to print money and not worry about how much gold reserve you have. So at the time when Subbu joined, I looked at this ratio too. The Dow Jones to gold ratio was 10 in 1996. When you had that tech bubble and everything went crazy by 2000, that ratio was 40, which means that the Dow had inflated and gold had still remained pretty much, the ratio went up to 40. And then, of course, in a bust, it went back to 10 and now it's around 20. So, in a very similar way, the monetary base of the world is no longer linked to gold. The monetary base of the world is linked to a desire of a Janet Yellen or of the ECB or any central banker down the world to rescue someone or the other. If there's a crisis, you print money and you try to rescue, right? And you rescue the people who caused the crisis after the Lehman. You rescue the people, you rescue large companies and hedge funds after COVID or even in the LTCM crisis of 1990, 1997, or the Asian crisis 97 and the LTCM crisis before that. So the banks are now in the rescue operation mode, right? There is a debt fund crisis in India. Rather than having the mutual fund houses suffer for the problem they called, the Reserve Bank of India will open a tap and say, I got 50,000 crores, ready to refinance you if you're in trouble so that you can start returning money if there's redemption pressures. So the central banks have become rescuing of large groups rather than trying to have a discipline and saying, hey, you made a mistake, you suffer for it. And that mistake era was the gold standard because it limited how many dollars or euro or rupees that you could print. So since 1971, the US dollar has lost about 99% of its value against gold. Why do I say that? 1 ounce of gold on August 15th, 1971 was about $32, 1 ounce of gold. Today, that same ounce of gold is now trading at $1,900. So that's where it's lost to me. If you had a choice in 1971, August 15, should I keep a dollar bill in my pocket, right? Oh, sorry, should I keep $32 in my pocket or should I keep an ounce of gold in my pocket? The $32, even after you add interest from the US, from the US government, 4 or 5% compounded, is worth, say, $500. And gold sitting in your pocket is worth $1,900. So gold has outperformed, even assuming that you had no tax on the interest you earned and the money was safe, et cetera, compounded over periods of time. Gold has done very well. And what we've seen after the Lehman crisis is 2008 till last year, 2020, the central banks around the world printed roughly about 12 to 14 trillion US dollars, 1 trillion US dollars a month, because there's no linkage to gold. And you saw the gold price go up. The gold price fell immediately after Lehman because people were selling, speculators were selling to get liquidity. But it's went from about $600 an ounce to about $1,800 or so an ounce last year. Then COVID hit. When COVID hit, we saw the spurt in gold prices initially. Why? Because again, central bankers are now printing $1 trillion a month, every month, as opposed to 1 trillion a year. It's 1 trillion a month, and Gold is a currency. So if I print so many rupees, my rupee will weaken against a dollar. If the US dollar Fed starts to print a lot of dollars and the ECB prints less dollars, prints less euro, then the dollar will weaken because there's more dollars and less euro being printed on a relative basis. So gold is another currency. It's not paper, but it's a currency of hard metal sitting in a pocket or in your vault in the quantum gold ETF or in the quantum gold savings fund. And that currency, relatively to the rupee or relative to the dollar, in my view, can only increase in price. It may not happen on a day to day basis, but that's the way I look at it. So I think gold should definitely be a part of your portfolio, which is why in that 12, 80, 20, it is 20. It's a significant part of the portfolio. And again, what we are offering and suggesting to investors is what people like myself at Quantum are also following. So we believe it's a tried and tested, mechanism.
Even on a return basis, Ghazal, from 1996 when I joined, the compound annual rate of return for gold is around 10.2, and for the Sensex between 96 and the end of 2020, it is 10.8. Right, so gold has been a very attractive investment. There could be periods when it may not perform well, but as an asset class, it definitely has a good position to be in a portfolio.
So, a related question: what the investor wants to know both of your views on cryptocurrency and whether it is a good alternative investment for a retail investor, just like gold is.
So I will give a very short answer. Ajit can probably elaborate it with a lot of views. To me, it still appears to be a very speculative product. There are still no regulations behind it as to how much of that currency could be printed. There is no asset backing it, and there are now too many of those currencies floating around. So while it may look attractive for certain people who want to take the risk, but to me, it appears to be still a very risky proposition. But Ajit may have a lot more views on it, so let's hear from him on that.
So yeah, I mean, I must confess that in March of 2020 last year, I did consider buying one buying one of this, Bitcoin. It was $6,600, and I said, should I just buy one and not for fun, for pure musty, And sadly, I did not. But even if I did, I'd have probably sold it when it went to $9,000 or something like that. But let me give you my views on crypto, right? The way I look at crypto is, so if you had a bank locker and you had some certificates or something gold lying in your bank locker, how would you get to that bank locker? You would enter the bank branch, you would show the branch manager your proof of ID, you would have a key to the locker, the branch manager would have a key to the locker, he would take you down the steps, dingy steps, put some light on, open a door, take you to the locker room, you turn your key, he'd turn your key, and you'd open it, and you have your gold inside. So what is crypto? Crypto is that I have a key, and it's something called, I have a key, and I say it's mine, and everyone, and this is blockchain, right? And everyone else will confirm through this technology, yep, that is indeed Ajit. So rather than one branch manager with a key, there are multiple people out there who are confirming that this is indeed Ajit and he's got the right key. So fine, we go to the locker and we open the locker. What do we have inside there? In my bank locker, we had gold. Oh, what's inside that? What's inside Bitcoin? I don't see anything. Okay, you confirmed I own it. And that's very nice of you to confirm that I own it through blockchain mechanisms. So if you have to have a currency, it's got to have a store of value. It's got to have an easy transaction price. There are certain characteristics of a currency. That's why it may take many, many years for even the Chinese renminbi to become a currency. There's a certain trust factor that's involved in it. So yes, between you and I, we can decide that seashells are a currency, and they were currency in the past. We can decide beads are a currency. We can decide that a blank quantum letterhead is a currency. We can decide anything is a currency. And that can be what's lying inside the vault after I've turned my key and claim it's mine, and you through blockchain have turned your key and confirmed that that piece of blank paper or the quantum letterhead you know, belongs to me. But what is there behind it, right? I mean, I can understand the need for crypto in the sense that you're trying to get away because of the secrecy. You're trying to get away from government scrutiny. You want to know that no one wants to know who owns it. Fair enough. I can understand it being a haven for, you know, dark stuff that you may want to do. But I understand the need for digital currency. A digital currency, Reserve Bank of India could issue a digital currency backed by rupees. Someone can issue a digital currency backed by gold. Someone a digital currency backed by Swiss franc. And I believe there are 60 or 70 central banks in the world, and China and Singapore, I believe, are in the lead, who are setting up digital currencies, but they have the backing of their central banks behind it. Who's backing what's in that Hava when I open that locker of crypto? So I haven't quite got my mind to thinking that, you know, I'm willing to pay something for that Hava which is there in the locker when I turn the key. So I'm not a fan of crypto. I don't understand it. I don't see. It's not because I can't pinch it. Uh, I can actually. I don't pinch my gold every day. I know it's lying in the quantum in the quantum gold savings fund or in the quantum gold ETF in a vault, and I have a paper that confirms that I own that many units of the gold which is in the vault. Fair enough. I don't have to touch it, but I have to know that there's gold over there. When I open that crypto, you know, safe, there's nothing in it. There's air. I mean, tomorrow I could launch, in some sense, my own cryptocurrency. So I believe I read somewhere that there are hundreds of cryptocurrencies out there, right? And you know, it's basically, to my view, a greater fool theory. I was willing to buy Bitcoin last year, not because I believed in it, but I was following what's called the greater fool theory principle, which is I'm fool enough to buy it at $6,600 for one Bitcoin, but I'll find a greater fool to buy it to me at a higher price, right? I didn't buy it because it's a value play or because there's something fundamentally solid in it. I bought it for musti. Little bit of musti you're allowed in life, but you should not put your, you know, life's goals based on musti.
Sure, Ajit. Thank you. Um, Ajit, you have often mentioned that the biggest challenge for India is employment for the millions of youth. And now, post COVID, unemployed numbers are swelling. So, the investor wants to know whether you think this is temporary or this is, a cause for concern going forward.
So, you know, it's not going to be good. I mean, Subbu was sharing some numbers, Subbu, on the salaried employed. You want to give those numbers and I'll take off from there?
Yeah, no, at the start of last year, not started, when the pandemic started, we had, I think, close to 19 million salaried people who had lost their jobs. And even as the economic recovery was picking up, I think probably around 12 million out of that regained. But there is definitely a 6 to 7 million job losses which have taken place. Now, these numbers, of course, on a month to month, they can change, but what was lost hasn't been regained. Net, there has been a loss, they need to find employment. Uh, so, 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 Ajit, you can take off from there, then maybe I can
Yeah.
add if it is.
So, you know, it goes back to what we said before, right? You have to keep in mind that much of the employment, even in the US and in India, and also true for Europe, is created by small enterprises. It is the small enterprises that account for 60, 70, 80% of job creation. Big factories, you know, whether you're a refinery or you're an automobile plant, you don't really create job creation in that factory. You create it in the supply chain, right? And it goes down the system in some sense. So it's very sad that GST, which I think conceptually created by the previous government, by the Congress-led NDA government, sorry, UPA government, and implemented by the BJP, I think was conceptually wrong. Uh, that's my view, and I think we're kind of seeing the effect of that. I think it was good to have a unified tax rate, which is to remove octroi. You could not have goods moving freely between states. There was a guy with khaki trousers and a pant and a dundee and a stick stopping at every border. That had to go, but I'm not sure whether GST was the answer, because I think GST again, as COVID, have hurt the ability of small companies to fight in the marketplace. And if they don't survive, how do they create jobs? So I think we've got that problem. And to that, you've added COVID, and it's not going to be a good society. I think we need to go through it'll be a good stock market, as I said. It could be a very good stock market, but not a good society. So, putting on my hat as a BA student of economics and looking at development economics, I will tell you I don't like where India is going. As a fund manager, I may tell you I like where India is going, but not as a development economist. So, I think that the answer is that small companies will not be around, and much of the job employment comes from small to mid-sized companies, not from very large companies. Exceptions are the body shopping or the technology companies, Infosys, Wipro. Exceptions are there, obviously. But generally speaking, if a cement company was to double its production capacity of cement, a large cement company, or a large steel company, or a refinery, for all the thousands of crores of investments that it will make, how many jobs will it create? 100, 500, 1,000? Now, if there was thousands of small companies investing that same 1,000 crores or 2,000 crores or 3,000 crores collectively amongst these small companies in their business, they'll create a lot more jobs. So I think that's the dichotomy of India, that and the world. It's not only India, that we have this very barbell view of the world, as an individual, as a human being, as a concerned citizen, that we're getting poorer in terms of society, in terms of distribution of wealth, though we may get wealthier if we are on the lucky end of the spectrum to have the surplus money to invest in stock markets. That is, I think, the best, you know, the I think that's the reality. Again, don't get me wrong. I'm not saying that having, that removing octroi was bad, but having a uniform service tax across the country, it's not there in the US. Florida has a different service tax level than the neighboring states of Virginia or North Carolina or Texas and everything else. And New York is different from New Jersey and Florida. They have different state level corporate tax. They have different state level service tax. They have different levels of tax because every state has its own pluses and take the state of Goa, right? So in the initial run of GST, Goa hotels had the same GST rate as a hotel in Bombay or Delhi, which doesn't make any sense at all. You go to Goa for a different reason. You go to Bombay for business. You go to Delhi for business to meet the government or whatever, to win some favors in government, etc. So it's different. Goa is competing with, the global tourism industry. It's competing with Thailand, with Bali, with Indonesia. It's competing with that. And now suddenly you put a tax rate which sort of prices Goa out of the global tourism industry. And that's Goa's main, advantage, the beaches and the fun that you have in Goa. Of course, now there are ports coming up and they're destroying trees and they're doing other stuff that's bad for the environment. But that's really what Goa was about. So imagine the hotels getting shut down, the shacks, the restaurants getting shut down because there's not enough business, because they're losing business in an equalized GST world to Pattaya, to Bali, to Bangkok, etc. That becomes a problem. And therefore, you lose employment. So that is a big issue for me. I think that as an Indian or as a person concerned about where India is going, one should be really worried about policy making from that angle. Money, you'll probably end up making more in the stock market because of what's happened.
How important is integrity and character of a mutual fund manager? Ajit, Subbu.
Repeat that
Well,
question. How do you?
How important is integrity and character of a mutual fund manager?
So it depends. I mean, it depends on what the investor's looking for. If the investor, I mean, if I'm buying Bitcoin, I'm doing it for musty. I'm not expecting any integrity out of the people who are running Bitcoin or whatever. So it depends on what you're looking for. If you are willing to play the game, then you don't care about integrity, you want returns. But if you want, it's really up to the individual. There is a reason why we don't have certain shares in our portfolio from 1996 is integrity screen that I spoke about. So we believe that the integrity of founders that we invest in, the integrity of managements that we effectively are backing by putting our client, by putting your money through the quantum funds into those companies is, to go back to what Manmohan Singh said when he was finance minister after the reforms in a July 1991 interview with Economic Times, 2 pages, beautiful interview. The one line, the one phrase that stood out for me in that whole interview was investment is an act of faith. It's an act of faith. If you're a multinational investing in India, you don't expect corruption and bribes and trouble. You're coming as an act of faith, right? And if you're a country accepting multinational money, FDI money, you don't expect bad stuff to come from that investor. You have to put guardrails to ensure that bad stuff doesn't happen. Similarly, on a portfolio side, when we buy shares of companies, we expect as minority shareholders that your money should be treated the same way as the founder's money. Ranbaxy was a classic case in point. We owned Ranbaxy in the portfolio. They sold out to Daiwa 2007-8, I think it was. They sold out to Daiwa, the Japanese pharmaceutical company, and the Singh brothers got a 35 or 30% premium to the share price. It was legal in the sense that SEBI allowed it. It was legal. It was like a non-compete thing. And I wrote an article then saying, hey, that's completely wrong. When the Singh brothers family, when Bhai Mohan Singh started Ranbaxy as a private company, that's fine. Once he IPO'd the company and listed it, just because the Bhai Mohan Singh family, the two brothers and everyone else, has more shares than us, doesn't demand a better price. If they are working in the company, of course, they get a salary, they get a bonus, they get ESOP plans, all fair cost for the game, absolutely fine, no problem at all. But they can't get a better share price than us. And we actually met their bankers, we wrote to the management, expressed our view, and the deal went through at the way it did, and we sold out. So integrity, in our view, is core to what we do. We can make blunders, right? We did not buy Yes Bank with the previous founders. We bought Yes Bank, we thought wrongly, with a new team that was coming in, with an RBI member, nominated member on the board, bringing more integrity and transparency to the process. So we can get those judgments wrong, but integrity is keen. And it's for you as people on this webinar and seminar and for others to judge how important integrity is. But integrity by itself cannot be a decisive factor, right? You cannot say, oh, Quantum Mutual is a fantastic fund house. They're highly integrity. I'm going to give them my money. They've got to be competent. They have to give you a decent rate of return for the risk you're taking by investing in the quantum products. It has to be matched with both. And competency, if you're competent and you don't have integrity, that becomes a risk. So there are reasons why we don't buy a Reliance, an SR, or a Vedanta. They may be highly profitable, highly wonderful business people, but there's something in their structure which doesn't give us the comfort to say, okay, we can trust that we as a minority will be treated as fairly as the founders. That's a judgment that we make. It's a judgment that you have to make too. And I don't have an answer to tell you, where you should lie, but I know how we believe in our company and how the investments we make. And we can make mistakes, in which case we have to course correct, either as a company or, like I said, on the external world, when we make portfolio decisions where we made bad judgments of people, like we did in the case of Ranbaxy.
So, who would you like to add something to this?
Ghazal, I think it was quite elaborate. There is not much to add, but needless to say that that is a very important screen. Ajit did not use a funny way of expressing it. He said, when you shake hands with someone, please check whether you have got all your five fingers back, right? So that's the test of integrity. If you shake hands with someone, you need to ensure that you are being treated equally. So there is a need for integrity in businesses, and there is a need for integrity in what we do. So I can't be telling you that I will buy liquid large cap stocks and then have around 10% of the portfolio in small cap, so that I can show the returns. That is lack of integrity. So what we say, we need to follow, and same thing we would expect in companies as well. That there could be mistakes, but what has been stated, that should be followed.
Thank you, Subbu. Um, to the both of you, would please suggest some good books on the psychology of successful investing for our investors.
So repeat that again, Ghazal, or lost that? Sorry, what's that?
Can you suggest a good book about the psychology of successful investing? Investors
Subbu reads
asking.
books.
So see,
Yes.
if you are looking at behavioral investing, then there is one very good book called Behavioral Investing by James Montier. So there are a lot of books on behavioral investing, but this one book is quite elaborate and very well written. And to some extent, it's also academic. So if you are looking at behavioral investing, then this is something which I would suggest. In general, about investing, there are a number of books, but right from security analysis to One Upon Wall Street to Penny Wise Pound Foolish, many books are there. And there is one which I recollect Ajit had given me when I had joined in 1996 was random. I think it was
Random
called
Walk Down Wall Street.
Random Walk Down Wall Street by
Burton
Burton
Malkiel.
Markle. It
Burton
was a
Malkiel, yes.
wonderful book to read. And there are many as well, which are very funny and well written. There is a book called Where Are the Customers' Yachts? I think that's also a very well known book. So some of the old books are quite good. On behavioral investing, you could look at this one book which I said.
Thanks, Subbu. And
But always
finally,
remember, like as one, sorry, I'll just add over here,
sure.
Ghazal. I remember in one of our Equity Master events, Mr. Ramesh Damani was speaking. And as you know, he is a very successful investor. And he said, while you read all these books, just ensure that you don't end up becoming a librarian. And you should go out and actually invest and experience investing. Then you will actually make your wealth. So reading is one, applying it is different.
Thank you, Subbu. Noted. So lastly, finally, my question to both of you is what are the plans for quantum going forward, the next 25 years probably?
Ajit, go ahead.
Well, I certainly would expect not even the next 25, but in the next 3, 4, 5, 6, 7, that, there is another generation of, brilliant minds and fabulous people that Subbu has trained over the years, and that they are on the screen, and neither Subbu nor I are on the screen talking to you all, because they reflect the same values and philosophy that we have. They reflect the same discipline that we have, and the same competence that hopefully we have, over the decades. And I think that's the key thing, that passing on the baton, handing on to the next generation in a smooth way, to me is the big win. That no matter where I am, if I could have one peek at quantum, that's what would make me very happy. Ghazal, you're an upcoming rising star, right? So people like you sort of are the future of quantum, and there are so many of you all in quantum. I think that, and the vaccination rules kind of showed that, right? Because I'm above the age of 60 and I got my vaccination quickly, and most of you all are below the age of 45, and you all had to wait for a long time for the vaccines. And you all have 20, 15, 20, 25 years ahead of you all. So I think we've just about built something of, which is sound and which you all can take forward. And I do hope that investors recognize that, customers recognize that, and they start allocating more and more of their capital to the quantum suite of simple products that we built. And you'll be great stewards of that trust and capital going forward. So that'll be my hope and my vision of quantum.
Thanks, Ajit. Subbu?
So both in terms of as Ajit said, the we have trained a lot of successors, and all of them are very competent. Uh, I would also like to see the company becoming both in terms of larger in terms of AUM, deserving what or taking a share of what it deserves. Right? Today we have a market share which is very, very less in the AMC. We think we have a good suite of products and good set of people to invest with, and therefore I would look for the size of the company to become larger without losing any of the characteristics of integrity and all of those areas. The other very important factor for me personally has been that when I joined 1996, right, I would not have stuck around in a company for 25 years if the work atmosphere was not good. So I think we have a good work atmosphere. We encourage a lot. We train people. We encourage them to go out in a normal time, non-COVID. Our research analysts would be out there meeting companies. Across the board, I would say in every team, we try to encourage as much as possible in terms of their learning and improving their abilities. And that should continue. That gives a very soft character, but a very important character, that as to why people stick with a company. We need to be competent. We need to grow the business. We need to earn profits for our shareholders and for employees. I agree, but the work atmosphere has also to be very good and enjoyable. Right? 1996 again. Ajit said, if you don't feel like coming, you have a headache, stay at home.
Correct.
Or you come to the office, you have a headache, walk across to the sea. And me
Right.
and Riaz and others have walked on A Road. Our office was very close to the ocean. We would work for half a day. We don't feel like working. We would walk across to the sea. So that's the kind of freedom you require to attract and retain people. And I think in future also Quantum should continue to do that.
If I can, I think Subbu raised a very important point that I spoke about you all, but didn't talk about the culture. Last year, a year ago, when we we're all working from home, we went through this exercise of culture at Quantum. And there's a handbook downloadable on the Quantum AMC website, which is the comments that we got from team members working from home in the first 2, 3 months of wave one of COVID, and what they thought was right about Quantum and what they thought was wrong about Quantum. It is not edited, it is up there with their views on it, with what they think was also wrong and what they think is right. And that's something that's very close to our heart, right? We build something, like we said, like we don't feel like coming to work, stay at home and we'll still pay you the salary for the day. Don't worry about it. We're not going to mark you absent. So the HR team has got a very difficult challenge because, of course, HR has all the mechanics of holidays and who's taken leave and all that stuff, but also of most important of ensuring that the culture, the tone at the top, that philosophy of the people who set up Quantum, the philosophy of Subbu and me that has streamed over the years, it has to actually percolate down, has to be absorbed and enhanced by all of you all, by you, Ghazal. In fact, I'm going to flip this around to you, Ghazal. I'm going to ask you that what have you felt by being in Quantum over these years? How's it been for you as a person? What do you not like? What you like? I don't want to know. What don't you like about Quantum? Actually, you can even tell us what you like. It's fine.
I'll start with what I like, Ajit. It's definitely, like, particularly in my team, there's this balance of learning as well as giving me responsibility. So autonomy and like my duties and responsibilities are very well balanced. It gives me, my own way and my own space of like approaching things. My ideas are listened to, they are appreciated, they are included. That makes me feel like, part of the team, part of the process, that I'm making an impact, like that I'm part of the end result. And that is really a big motivator for me personally. So this work environment where everyone is treated equally and is given importance and heard is a big motivation. Is one of my favorite things about quantum.
Great, good.
All right, then, with that last question, we have come to the end of this webinar. But before we wrap up, I will request our speakers for their closing comments. I will request you to please tell us that in retrospect, what are your learnings and maybe what would you have done differently?
So if I may go
Yes, Subbu,
first,
starting with you.
yeah, as I may go first, as I said, from a learning point of view, there is always refinement to be done in the research process. There is always refinement to be done in terms of picking stocks, when to trim, when to sell. So that's a continuous learning process which is on and which needs to continue. Team structure is very, very important, right? We have always built teams. We have never had one star manager out there selling and raising money, and that should continue. We work as a team. When I say work right now, I'm referring to the research team. But even as a company, we all have responsibilities in different areas. But the joy is when you work as a team, and I just wish that Quantum continues to do over there. Again, from there, I had already shared with you the learning has been that I wish we had more women employees in the research team. So we had more women fund managers. In hindsight, that is what I would say are some of the learnings which I had. Uh, there are many points which come to mind, but I just shared with you three or four bigger points. And of course, size. The AMC has to become. I think it deserves to become a much larger company than where it is right.
Thank you, Subbu. Ajit.
So I think that, we had this approach, which may have been wrong, kind of build and they shall come, which has worked very well for China, by the way, as a country. They built infrastructure and people have used it. And, we built this, to me, a fabulous, quantum has been an experiment on multiple ways. It's been an experiment of high integrity, of high competence, of learning, making mistakes, building a team, building a partnership. It's not called Dayal Fund Management Company. There's a reason why we chose, a neutralish name, if you will. And it's all about trying to build something of lasting value, something which is useful to investors and to society at large. Some of you all may not know this, but we were the first fund house to come out with this Smile kind of product where help your NGO, a database of NGOs, and the money in your quantum mutual fund can be linked to give a continuous benefit to a whole bunch of NGOs of your choice. So we'd like to do things which we think help society around us and without compromising our return that we have to give investors, and certainly not compromising on the integrity. So I think the mistake should have been that, internally we should have been shouting a little more often, being out there and kind of taking a thali and banging it and saying, this is who we are, sort of thing, making more noise to a large extent. And I think the other aspect, which, nothing that quantum could have done, but something which I personally have been disappointed with, has been the sort of the regulatory environment in which we've operated, not only in India, but even globally. So after the Lehman crisis, we've seen rules and regulations imposed on our businesses, which are far more damaging or far more costly or far more onerous to smaller companies than they are to larger fund managers. And the larger fund managers can pay a bill, but a smaller entity will not survive in some sense. Quantum is lucky. We've grown in size so survival is not a question. But it would be silly on the regulator's part or silly on our part in Quantum to assume that the brightest fund managers are sitting in Quantum. You're all very bright, don't get me wrong, and or in other fund houses. I mean, in America, you can effectively launch a mutual fund with $100,000 of capital. That's like 73, 75 lakhs of rupees. Whereas in India, you have to have 50 crores of rupees and 3 years of profit, or 100 crores of rupees net money in the bank and no profit, and you get a pass to manage money. Managing money is about the mind. It's not about how much money you have in your pocket. So I think this whole idea of skin in the game, that you have to have a high net worth or you have to show that you have a lot of your money locked up in the fund, that doesn't work for a liquid asset class. That skin in the game and locking up your salary is perfectly sensible for a venture capital fund, for a private equity fund, where the investor's locked in for 10, 12 years and you want to be locked in too. That's what the international clients want, and that's fine. Our international investors, the largest investors in the world, the smartest investors in the world, they don't have a requirement for us to have skin in the game. They do ask how much of our money is there. And I think for the last 4 or 5 years, the Quantum Annual Report, we show collectively from the directors, from the founders, from the team members, how much of our money is in every product. So I think the regulatory environment has turned very nasty against small scale fund managers or professionally run firms in some sense. We're all being asked to be converted to a hospital when hospitals don't solve the problem. Good professionals will do the job, in my view, far better than a large hospital complex would do. So that is a bit of an external disappointment that post Lehman and post all the crisis, the environment in which we operate has become far more unfriendly and for smaller companies and far more friendly in some sense by default because they use money as a criteria to judge how good or fit and proper you are. And that's been, that's not good, I think, for investors in the long run.
Sure. Thank you, Ajit, and thank you again, Subbu, for being here with us today. It was a pleasure to have you here. And I would like to thank all of you investors, viewers for joining in and being a part of the celebration. We will be concluding the session now.
And thanks to Subbu for 25 years.
Thank you. Thanks, Ajit. Thanks, Ghazal. Thanks, the whole team. And thanks, everyone, all the people who attended.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.